we still see there being more to go in this restart narrative.
It's still being affected by concerns about COVID.
The biggest risk for me is that I underestimate how much inflation is going up.
The Fed doesn't know either when this transitory notion is going to go away.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Good morning on an unprecedented Monday. There is no other way to put it. The bond market and the linkage, the correlations into equities, commodities, and the rest is absolutely extraordinary. Lisa Abramowicz, Matt Miller in for John Ferro, which is a good and beautiful thing. Matt Miller's surviving Father's Day by all reports that we can.
How about Tom Keene?
No, I didn't survive it.
Okay.
Lisa, the 30-year bond, briefly in the Asian morning, under 2%. Stunning.
Stunning because basically people are pricing in the ramifications of a hawkish Fed before the Fed comes through on even being hawkish. A couple of members coming out and basically indicating that they'd be willing to raise rates, and the market extrapolates down into the future of slower growth and lower bond yields. Exceptional moment, Tom.
Want to go to the research board now? We've got tons of research to verbal to you this morning. That's what we do here. We summarize global Wall Street. Stephen Major, Dyer, and the team at HSBC out with a terse note. Both Abramowicz and I independently notice this note. We maintain our 1.0% forecast for 10-year treasuries. And then on the movement, the elasticities we're seeing, the new policy moves more slowly than a Taylor rule, but it does move.
Yeah.
The underlying inflation trend is likely to be benign based on GDP and PCE projections. Lisa, I go to GDP, and the turmoil we're seeing now is a guesstimate of where GDP is going.
The guesstimate of the ramifications of the frictions in the labor market, the ramifications of higher gas prices, higher prices in staples, leading to lower purchases, the dreaded S word, the pendulum of stagflation, Tom.
Well, it is in a new kind of stagflation. Well said, frankly. Matt Miller, I really want to go to what this means for Europe. I mean, it's sort of we're separating away hawkish central banks from Lagarde alone. Is that it?
I think Lagarde and the ECB have done a great job playing this to their advantage as you see a euro coming back down to 118. My question is, does the Fed strike back with the speakers today? You know, we're going to start seeing a lot of people are talking about the big central banks jockeying for a better position in terms of currency.
It is absolutely, again, I really want to emphasize the market coverage worldwide, absolutely extraordinary right now, and we'll really sit on it this morning. Tony Crescenzi will be joining us from PIMCO, I believe, in this hour. Let's do the data right now. Matt Miller, help me out here. You mentioned euro, a 119 exact, yen weaker as well, 110.11, and the dollar really not breaking out, Matt Miller, is it?
It isn't, but we've seen the euro and the pound come down pretty substantially over the past couple of sessions. So what you see here is just could be a dead cat bounce, as David Buick used to say. The point is the euro's not trading at $1.22 as it was pre-Fed meeting last week.
Equities surge in were weaker in Asia, and now they surge up 0.5%. SPX up 20 points. Dow, we do the Dow Futures from John Ferro.
He's
up
grateful.
200 points, 33,355. NASDAQ, was leading the way, not so much right now. Bitcoin, I should point out, 32,000, 33,000 right now. Lisa,
that's fascinating.
We need a brief.
Yeah, we do need a brief, and we will get to Bitcoin, I promise, Matt Miller, later on.
Yes.
I meant Dow Futures. I thought Dow Futures were fascinating, not Bitcoin.
Let's move on to what we're expecting today. We're expecting a number of Fed officials to come out and speak. Jim Bullard, in particular, of the St. Louis Fed, among them, which should be interesting following his hawkish discussions on Friday. Also, John Williams of the New York Fed, as well as Robert Kaplan of Dallas. These remote or these virtual events by the Federal Reserve, possibly giving some color to the dots raised forward, bringing forward some of those rate hikes. 1:45 p.m., President Biden is going to be meeting with financial regulators. Interesting to see the focus on regulators and global climate change, how much they are going to weigh in on this. That is his connecting force here. What kind of threat to the financial system could global warming be? An interesting conundrum, especially at a time when it it's not a clear link, and we still have a lot of other issues to work out within the financial system. And today, we have the Bloomberg Qatar Economic Forum. Very interesting roster of speakers, including Barclays' Jess Staley, Ray Dalio of Bridgewater. How much do they recognize the new regime, the paradigm shift that we're seeing reflected in markets, the deflating of the reflation narrative? How much do they buy into this, and how much are we going to hear from Ray Dalio? Cash is still trash, and we're going to get inflation pick up dramatically here, whether the Fed takes a more hawkish tilt or not, Tom.
Lisa, thanks so much. And we'll dip into the coverage there from Doha this morning. I know Mr. Bloomberg leading off that Bloomberg Forum on this Monday. Right now, David Page with us with AXA, investment managers, head of macro research. David, there's a huge divide out there. There's people looking out for higher yield, elevated inflation, and others who simply say no. Which is it?
We think yields will move higher, and we think it'll probably happen over the next 3 months or so, certainly from the depressed levels we find ourselves at the moment. I mean, the story on inflation, I think, is a transitory one, certainly in the short term, in the sense that we are seeing this big spike, and we do expect that to roll off. And we think there'll be increasing evidence that that's rolling off as we move into, the September months and after the summer, and that will add to the story. I think the key is, though, the Fed isn't really that worried for now about what's happening at the very short end over the next couple of months in inflation. It's really trying to guess what's going to happen towards the end of 2022, what's going to happen into 2023, what would happen into 2024 if they don't move. When you're thinking about dots moving, into 2023 rather than 2024, they're anticipating inflation much further out, not the next few months. And I think that's the key issue here. And I think once the Fed repurposes some of its messaging, I think that's going to come through both in real yields and to some extent in break-evens.
David, what could, though, trigger the increase in yields? If it's not a more hawkish Fed, the idea that the Fed itself is starting to see inflation pick up, what could possibly convince the rest of the market that they are wrong, especially if the Fed is showing a willingness to try to tame inflation should it rear its head?
Well, I don't think the Fed is suggesting that. I mean, there was a reaction that, the Fed only increased its inflation forecast to 2.2 from 2.1, and that's what led to this whole shift in the dots. And so the overshoot that the Fed was looking at for 2023 wasn't as much. And I think that's wrong. I think what the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation that is going to be persistently higher if they don't put themselves in a position where they can start to restrain that. And that's perfectly sensible from a central bank's perspective. They have extreme accommodation at the moment. Rates are as low as they can be. The QE program is extensive, and they're still not talking about tapering that, and we don't expect them to until December. There's a huge stimulus going through. We can see the problems it's causing at the short end of the market with some of the liquidity positions out there. And I think the Fed needs to work out how it's going to retrace some of that. So I think that's the story that they're going to communicate. That's where we're coming through at the moment.
So is this what we see in treasuries right now, what we see in the 30-year coming back below 2%? Is this investors all getting out there looking for duration? Are they searching for convexity to try and limit their exposure to interest rate changes?
I think to some extent there is a repositioning come through, and I think also there is a global factor here as well. I mean, we're still seeing, as we've talked about in previous sections, an ECB that's taking advantage of the international situation. There's elevated purchases coming through from the ECB. German bond yields are still trading at negative. And so you still get quite a positive carry from a lot of European investors if they allocate overseas. And I think perhaps some of that allocation into the US market is continuing to be there and will continue to be at something of a ceiling for treasuries. So we're not looking at a huge surge coming through, but I think some pickup coming through over the medium term is entirely likely.
David, how do you interpret trillions of dollars with no place to go? And the literature over the weekend is obviously overnight repo and the rest of it, all the fancy math inside of 6-month duration. And it's also the assumption that all that money will go into Bitcoin to keep Matt Miller positive and maybe the equity markets as well. But how do you rationalize, or how do you frame out trillions of dollars on the sidelines?
Well, I think you have to sort of see the distortions that it's going, and it has to feed into how the Fed reacts. So we are seeing, I mean, it's been exacerbated to some extent by the government's unwind of its own cash positioning at the Fed, and we can see that that's having some impact. We know there's a lot of liquidity coming through from households with excess savings, and that's creating a deposit issue. So all of that is affecting the short end, and of course that's rolling along to the longer end as well. But I think the Fed needs to consider what that means for monetary policy. We saw a tweak come through, don't forget last week in the IOER rate. They increased the interest on excess reserves. to try and offset some of the short-term pressures. But those short-term pressures will maintain when there's that amount of liquidity through there. The only way you can reduce that liquidity over a period of time is to stop creating excess reserves. Now, what we think the Fed is going to likely consider is a quicker taper than is in the market at the moment. So most are of the opinion that the taper program will follow what we saw last time around, i.e. it will take probably 12 months. We think that they won't start until January. But we also think that they'll probably try and do it a little bit quicker than they did last time. So we think they'll close that taper within 6 months.
Right.
And I think maybe when markets start to consider a quicker taper, and therefore obviously if they finish a little bit more quickly, the possibility of an earlier rate hike, that's something that will help the liquidity situation. Now, I think there are 7 members of the FOMC that also think that the taper will be 6-month one, because I don't think 7 people can vote for a rate hike in 2022 if they still think that the Fed is closing its QE program by the end of that time.
In English, David Page, thank you so much. And folks, that's what we're searching for here all through the week on Bloomberg Surveillance, is some clarity to the complexity of the moment, given the record fiscal stimulus back to 47, 48, and certainly different than it was coming out of World War II. Lisa, the word I'm using here, and I think it was Sarah Vellis that had it in a note at Deutsche Bank, is responsiveness, which is English talk for a arcane word called elasticities. Do we know the elasticity of the spread market? We don't have a clue.
Well, right now, it's highly elastic. It's being incredibly resilient. You're seeing spreads stay very much tame, yes, widen a touch. But right now, there's still money pouring into anything with yield. And we have seen that persist regardless of concerns about growth. And so, Tom, that is why the Fed is not that concerned. They're not seeing any material disruptions to financial conditions, even with a hawkish tilt. This is significant.
I really agree with it that folks, what we see here is a lack of instability, and that's what everyone's watching for. With that lack of instability, though, is a lot of worry, and we'll try to address that. Tony Crescenzi with us here. I believe in this hour, some other good guests coming up. We're thrilled to bring you Benjamin Emmons. He's with Medley Global Advisors. It's a perfect day to talk to Ben Emmons about, well, all the speakers. Who's speaking? Let's see. Bullard. This guy, Abramowicz, is speaking. This is Bloomberg.
I just keep speaking.
With the First Word News, I'm Rishka Gupta. The 2 main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. And UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness nearly $21 billion of annual R&D spending to find solutions for the public good. The new Office for Science and Technology strategy will be headed up by the government's chief scientific advisor, Patrick Vallance. Property website Rightmove says UK house prices grew more slowly in June as a lack of availability drained momentum from the market. Asking prices rose 0.8% this month after a 1.8% gain in May, but the increase is still the largest for this time of the year since 2015, boosted by people seeking to leave London and look for more space. The Tokyo Olympics will limit the number of spectators to 10,000 people per venue to reduce the risk of the world's biggest sporting games turning into a super spreader event. The organizing committee chief says the number will be set at either 10,000 or 50% of venue capacity, whichever is smaller. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We We have proven now over the course of the past few years that we can reimpose sanctions in a devastating way, and the Iranians understand that. So we retain substantial leverage. We will come to the table not just with sanctions leverage, but with a united front of the world powers that will pose to Iran a choice.
Jake Sullivan of the White House on Fox News Sunday there. We thank Fox News for that moment there on Iran. It was good to see Golnar Montevalli of Bloomberg News earlier with Francine Lacroix with her true authority on Tehran and the events that we see. We'll have much more on that through the week as well. Right now, and this is really difficult to admit because he really wasn't my first choice for 6:18 in the morning, and he wasn't my second choice. But Marty Schenker was our third choice of guest this morning, which begins to filter out ranked choice voting.
I was my wife's third choice, too.
Yeah, that's
My
good.
goodness.
Here we are with an experiment. Let's get back on track, folks, or Mr. Schenker will show me the door. They've tried it in Maine. They've tried it in Oakland. They tried it here. Republican, Democrat, they've tried it. What makes New York City, for our listeners and our audience internationally, what makes New York so compelling as a ranked choice experiment?
Well, this is the first time New York City has tried ranked choice voting in any election. And being the mayor of New York is such a critically important post. Some people consider it the second toughest job in America. Having a ranked choice is causing some confusion, some anxiety, and people really have a hard time understanding what it is.
That's where I want to go. I mean, I'm fascinated, particularly in the complexity of New York City, how it affects turnout because of its complexity. This is a serious issue.
Yeah, there are
Is it complex?
Yeah.
Doesn't seem that complex to me.
Well,
that's okay, Matt. But
you
to
must be
lot
a
of
math
people
major
here,
then.
It's a big deal here, just looking at the ballot, what to do.
Yeah, I think what is giving some people pause is the idea that you really have to examine the entire field. And when you go in the ballot box, you're going to be faced with picking your 5 of 13 Democrats ranked by your preference. And it's that second choice that is critical in this whole process. The person with the most first place votes, if it's not 50%, then the second place choices get allocated. The last first place vote getter is eliminated, and that person's votes are allocated to the second choice. So it could be that the person who's elected mayor would not be the first choice of a majority of the voters.
You got through that at 6:15 in the morning. That was spectacular.
Which is why Andrew Yang has teamed up with Catherine Garcia to try and push Adams out. As I was reading this fantastic Bloomberg coverage over the weekend, my question really goes to the crime in New York. How bad is it? And has crime gotten worse because of the pandemic, Marty, or is it because of the choices of the current administration?
Well, I think that many of the experts do attribute it to the ancillary effects of the virus, the depopulation of the public transportation system, making it less safe. But the point is, I do think public safety, quality of life is the number one issue that's going to decide this race. Eric Adams has clearly staked out that as one of his most important points. But Andrew Yang has done that too. And so it'll be very interesting dynamic to see who wins that race.
What's great about this is Lisa's going to vote. She's going to leave the first 4 votes open and just have a 5th place vote.
You could do that, I guess.
I'm just going to put Tom Keene,
Please.
and let's say everyone at Bevelman's for some martinis. There is a question. I will just say this also. All of the advertising that I saw on the sidewalk, all the people pestering you to vote, were saying, if not for number 1, put her for number 2. And so people are definitely trying to cater to this ranked system, Marty. Looking to Washington, D.C., aside from New York City politics, there is a question of this bipartisan bill that seems to be gaining steam. I am interested in the headline number of it, just north of $500 billion. Is it really coming down all that much, or is it being viewed as sort of a siphoned off infrastructure plan with additional support for a bigger project down the line?
Well, that seems to be the Biden strategy, and today's a pretty important day. Apparently, Joe Biden is going to get briefed by this bipartisan group in some way today. The biggest question is how to pay for it. The bipartisan proposal of a graduated gasoline tax is a non-starter as far as we can tell from the Biden administration. But if they can find a path for paying for this, it looks like Joe Biden wants to get this bipartisan bill through the Congress and then take on the multi-trillion-dollar social welfare plan that he has proposed for America.
Marty, when I hear this, I just think that he's basically conceding to a much smaller fiscal spending package than he initially set out to do, simply because it seems a lot less likely for him to get consensus among Democrats to push through this larger multi-trillion-dollar plan. Am I wrong?
No, you're not wrong. You're right. The key thing, I think it looks like they can get this smaller infrastructure bill through, and I think both sides can claim victory. The biggest problem Joe Biden has is keeping his moderate Democrats in line for the bigger spending plan. Joe Manchin and Christine Sinema have not said which way they're going to go, and without them, it's just impossible to do.
Marty Schenker, thank you so much. Bloomberg editor at large and managing editor of ranked choice voting here at Bloomberg Surveillance. I always come in at fifth place as well. Lisa, I want to look at the 10-year yield. Just keep it real vanilla here. It moved out over 2 standard deviations, lower yield. We broke through the 144 level. The shock of these lower yields, and of course the tendency, as HSBC says, down to even more shockingly low yields. Is that in the market?
I don't think so. I would think that the economy would have to slow down materially for these yields to really make sense.
Exactly.
And if that were the case, wouldn't we see a more risk-off tone? Aren't we looking at a more stagflationary environment where the Fed forestalls growth, it forestalls inflation by raising rates sooner, leading to these ultra-low yields? Shouldn't that mean lower profit margins for a lot of these riskier companies?
Yeah, but we don't know the sequence of that. But to your point, and I, of course, focused on this last week as well, the real frame out here is the sub 3% growth rate. Will that occur, and when will that occur?
And I also think that there is the global nature, and we've been talking about this, but how much is this foreign investors coming in, which we saw with the strengthening of the dollar last week? How much can yields really rise in the United States if the rest of the world does not recover at pace? And we've seen little pockets of outbreaks. I don't understand exactly how this can continue this way,
Matt
Tom.
Miller, is this followed in Germany? I mean, are people in Germany following on the street? Are they following what the Fed is?
Well, on the street. Not on the street so much, but certainly followed in Germany by those in finance incredibly closely. And it's so important because the ECB and the Bundesbank have to follow it so closely as well. I think everybody on the Bundesbank board is waiting for Lisa's next opinion column. Lisa, when is it coming out?
Should be this week sometime. Break exclusive.
We ranked it.
Oh, yeah? Where is it? Number 8?
In 4th place.
Well,
but
winning.
The 3 on top didn't get a majority of the votes, so you still got a chance for essay of the week.
That's so kind, Tom.
Coming up, the interview of the day on the short-term bond market, Crescenzi of PIMCO. This is Bloomberg. Good morning. Good morning, everyone. Bloomberg Surveillance. Matt Miller in for John and Ferro, Lisa Abramowicz and Tom Keene. Bloomberg Surveillance to get you through fascinating markets. Futures up 18. Dow Futures up 188. We quote the Dow for John Ferro. The VIX goes out 15 out to 20.19. It's in a little bit better today, but 20.19 right now on the VIX. This is the interview of the day on the shock and awe of the short-term paper market 6 months in. It is arcane, it's complex, and you've got to read the 14,000 pages of Steigums written by Tony Crescenzi to understand a little bit of it. We don't have the time to do that, so we'll talk to him instead. Crescenzi of PIMCO now on where we are. Tony, there are two groups. The Fed is organized, the Fed is providing stability, and the overnight market surge we've seen in repo is no big deal. There's another camp that says baloney, the world's falling apart. Which is it? Bring the chart up, Brad, for TV and on radio. All you need to know, it's a spike like you've never seen. Think about Jeff Bezos going up in space. That's what the spike looks like. Tony, what's it mean?
Well, it's as if the Fed wrote its recent framework on disappearing ink to some, because the Fed's new framework, released last August 27th, said that it wouldn't raise its policy rate until the inflation rate had gone above its 2% target for some time. It hasn't really done that for some time, and so hence the idea of disappearing ink. This spike we're seeing in rates, of course, relates to the Fed's communication. And I should add that Ben Bernanke, who's an advisor to PIMCO, has famously said that Fed policy is 2% action, 98% communication. It goes to show how strongly markets take the words of the Federal Reserve, and certainly they were taken very strongly. So the rising rates, just to sum up, I would say that it's as if the Fed has put the inflation cop back on the beat. It wanted to regain control of the inflation narrative because the public's hype over inflation had gotten too high. The Fed got spooked. That's what it says. And it'll probably be good, final words, Tom, on this. It'll probably be good for the equity market, for the credit markets, private investments, including real estate, because it looks like it will rein in inflation fears.
Right.
But the Fed may
Okay, but Tony, this is really important. If Crescenzi's telling me the Fed got spooked, that's really, really important. What about the responsiveness, the malleability, the dynamics, the elasticity of trillions of dollars? I don't understand the theoretical model of what that money does that came from this pandemic.
Well, we see 750 billion of it in a Fed repo facility. There's still a lot of money sloshing around, and it's the reason why the Federal Reserve raised a few official policy, I should say technical policy rates that it tracks. It has its official policy rate, of course, is around 0, but it does things to tweak behavior in the money markets. And last week it raised 2 specific rates by 5 basis points because there's so much money floating around that it was putting downward pressure on money market rates, call it commercial paper, et cetera, and 3-month LIBOR, which reached an all-time low of 13 basis points last week. And so that money still is out there, so to speak, and it won't be removed for a long time. Remember, the Fed is still purchasing $120 billion of new securities per month. In other words, it's printing another $120 billion of money each month. It'll do so into next year, and it won't shrink its balance sheet for a while. Why? Because it's going to reinvest the principal and interest payments it gets on the mortgages it has and the treasuries it has.
But Lisa, I don't mean to interrupt Tony, but this is so damn important. Lisa, what's so important, and Mr. Crescenzi just said, is that phrase, for a very long time. I mean, that's really what the market's arguing about.
Yeah, the issue here is that people are trying to extrapolate forward what the trillions of dollars in excess cash sloshing around that clearly banks and the Fed are struggling to know how to handle, what the ramifications for this will be. Zoltan Pozar of Credit Suisse writing in a recent note that by paying trillions in reserves, 5 basis points, the Fed just planted the seeds of the next liquidity crisis. Tony, do you agree?
No. For one, markets understand the Federal Reserve's reaction function, which is that if there were a liquidity problem, that the Federal Reserve would stand up and inject additional liquidity. This is something we learned after the GFC, the global financial crisis. There was some doubts about whether the Fed would stick to it in 2013 when there was a so-called taper tantrum, when there's a fear like now that the Fed might remove its monetary accommodation. That fear subsided over the years, and look today. The Federal Reserve has communicated an idea that the markets didn't believe in previously, yet the reaction was not much of a reaction. It's rather tame. You're not seeing meaningful movement in global markets from this, i.e. Downward movement in equities, credit, and or jump in interest rates. And so it's a rather benign notion related to the reaction function idea. So this notion that if there isn't enough liquidity, there'll be liquidity crunch is not happening in my idea. One quick notion, though, to think about is the idea of chaos in periods when credit cycles end. After 2008, 2020, we all saw that credit instruments did not trade well. This relates to the breakdown of the so-called principal agent model,
right?
Which is that there are so many debt securities in existence that when investors go to sell, that the system can't handle those securities because there is no intermediary to bid for them.
Yeah.
So that's where there's a liquidity crunch in financial markets, in debt securities, because the problems in the broker, the principal agent model.
And Tony, that sort of speaks to the so-called taper tantrum type model, particularly in credit, because it isn't traded in the same kind of way as full faith in credit, government debt of the United States. Here we are, though, with two-year yields moving. And as a number of analysts noted, people expressing the hawkishness heard by a number of the Fed members in markets, but not, as you point out, in credit. We are not seeing the stress in risk assets. How do you make sense of this?
Well, first, I thought the first thing that came to my head when you said that is corporate profit story, cash flow. What investors care about, bond investors, equity investors, is cash flow. A bond investor cares about getting his or her or its money back. And the earnings story is quite good. In fact, we think the equity that investors should be overweight equities today, overweight credit. The story in equities is that the earnings will grow near 30% this year, and we would project as well that earnings will grow 10% next year, 10% the year after that. The Federal Reserve's communication, if anything, will elongate the economic expansion by tapering, I should say, bringing down inflation expectations, inflation fears, the type that might have truncated the economic expansion. And so the story is looking good. And again, I refer back to the notion of the Fed's reaction function. Most believe that the Federal Reserve would step in and take action if, in fact, the markets got into trouble.
Tony, I wonder about the renewed, as Sven Rahm calls it on the MLive blog. Hey, Tony, good to talk to you. He says there's a renewed quest for duration, and I wonder if that just points to market expectations of real volatility coming back in rates.
Looking out several years into so-called forward rates, one sees that, and even out 5 years, that the market consensus is that interest rates across the yield curve will be in the low twos. In fact, that's down 20 basis points in the past week or so. We would say that the 60-40 model is alive and well. Returns have been quite good this year, call it 7 to 8% or so. We still believe in the hedge value of high-quality fixed income instruments. And I said earlier that we prefer to be overweight credit, overweight equities, overweight private assets, including real estate. But that's not a very balanced portfolio. We would say then that the way to balance that is, of course, through the use of duration, having fixed income in a portfolio, because in the long run, adverse scenarios will affect treasuries in a way that benefits a portfolio, while the other instruments don't fare so well. So we believe in the hedge value of treasuries, and the 60-40 model is still 60-40 model is still big believers in.
That's a shock. I've been terrified to check my IRA over the last couple of years as we continue to hear that the 60-40 model is dead and gone. Why was that? And how come you think it's healthy and surviving?
Well, thinking first of the returns for the year, which are quite respectable, call it 7-8% or so is a fair return. And it's very difficult to surmise that in a quite adverse scenario that longer-term treasuries, and this has been demonstrated in the past week, would not fare well in an adverse scenario. So last week, a microcosm perhaps, when the Dow Jones Industrial Average was falling 500 points, longer-term treasury yields were falling. And this is the sort of behavior we would expect in other adverse scenarios, and they could be prompted by numerous things that are difficult to predict. But we do believe that investors would move in that way. I should add, finally, that the reach for duration is a global story, and this is obvious in Germany, where yields are still in negative territory, and also in Japan, of course, where they're near zero.
All the way out to 30 years, practically.
Correct.
Yeah.
And so the reach for duration, the need for it is still high. And the final note is, in 60-40 models, because of the performance of equities, if anything, there's likely to be some adjustments by large pension funds and other investors following it into fixed income, especially given some of the volatility of late.
Tony, got to leave it there. Tony Cosenzi, thank you so much.
Thanks so much, Tom. Thanks, everyone.
This morning. Lisa, I want to go back to what you had out earlier this week. You were leading on this, which is the difference in yield between the 5-year and the 30-year. What does that signify?
What it signifies is slower growth long term. That basically people are pricing out that reflationary push that we saw earlier in the year. My question is, how consistent is this? Going back to your question, how consistent is this with risk assets rallying? How much do we start to see a lower growth scenario priced into assets that have been flying high on the expectation of perhaps we're entering a new period of time of fiscal spending and low rates?
And you dovetail those two conflicting ideas with the idea of when the money begins to drift away, this wall, this mountain, this Game of Thrones wall of cash that we have. And if that's a long time away, this sustains this really unique position we're in. We're going to stay on this theme through all of surveillance, not only today, but this week, I believe, with a lot of Fed speakers coming up on the pandemic, on India, on Delta. Joshua Sharfstein, John Hopkins, next. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. Authorities in Hong Kong will shorten quarantine time to 7 days for fully vaccinated residents traveling from most places. They're also set to cut the requirement for non-residents who are vaccinated. These are the most significant moves yet to ease one of the strictest border curbs in the world. Other plans include lifting capacity restrictions at some restaurants and swimming pools. The board of Next Digital has reportedly agreed to suspend operations of the pro-democracy Apple daily newspaper in Hong Kong. The move comes after police there arrested top editors at the flagship newspaper of media tycoon Jimmy Lai, and national security officials froze its bank accounts. The board will apply to Hong Kong's Security Bureau to unfreeze the paper's assets and says it will decide on Friday whether to seize Apple Daily's operations. European natural gas extended its unprecedented rally as supply curbs sent prices to their highest level in nearly 13 years. The gains are fueling concerns about inflation. Gas is so scarce in Europe that some utilities have turned to burning more coal, a setback for the fight against climate change. Israel's new foreign minister is set to travel to the United Arab Emirates next week. It will be the first ever visit to the Gulf country by a top Israeli diplomat. Foreign Minister Yair Lapid's visit comes after the two countries normalized relations last year in an agreement brokered by the Trump administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If we were able to do it for COVID, why not for cancer? Why not for Alzheimer's? Why not for many other diseases? There is some lessons learned, and thinking out of the box and re-engineering your processes and investing in R&D, creating a culture that can do the impossible possible, and investing in digital is key for the success in bringing new breakthrough innovations to the world.
Dr. Bourla, Pfizer, you really wonder, is he going to line up for a Nobel Prize, what Pfizer and Moderna have done to help all of us in this pandemic? Over the weekend, I kept looking for a definitive article on India Delta variant, and that would be Anna Gross, Lila Abood, and the wonderful John Byrne Murdoch in the Financial Times with a tour de force, I believe it was yesterday, on the dynamics of this variant. Joshua Sharfstein joins us from Bloomberg School at Johns Hopkins. Dr. Sharfstein, I'll cut to the chase. Everyone's looking at the United Kingdom, and Lisbon and Portugal seem to be the worst right now on India Delta. Let's start with a why. Why are pros like you looking to the United Kingdom?
Well, because the United Kingdom is pretty highly vaccinated, but is also now seeing an increase in infections, and overwhelmingly these infections are the Delta variant. So this is sort of the next chapter of the COVID pandemic, and just reminds us that for every move that humans make, the virus has another one, and we just have to continue to press the case against the pandemic.
Dr. Sharfstein, how is the Delta variant different from all other variants? The idea here being if you're vaccinated, you're still highly protected against it, right?
Well, you really need both shots to be protected. One shot really doesn't do that much for the mRNA vaccines. That's one difference. But in general, vaccination is the best protection against the Delta variant. It's just that there are still a lot of people who aren't vaccinated, may have decided to wait it out. And that is not a good decision given the transmissibility and the lethality of this particular type of virus.
There is a concern, especially with the prevalence of only one-shot vaccinated individuals in the United Kingdom, of not necessarily Delta, but Theta, Eta, Epsilon. The idea here of all of the additional pile-on variations that could spring up. Are we seeing evidence of any further mutations?
Well, the virus is constantly mutating. So I'm sure there is evidence of that in countries around the world. And as long as that virus has billions of chances to replicate every second, really, then new variants can come up. There constantly are variations in the virus. And the question is which ones make it more transmissible and more lethal. So we're fighting against an enemy that is constantly changing. The best thing we can do is give it fewer and fewer opportunities to do that.
Fewer people are dying, that's for sure. Do you start to think we need to shift what we're counting in terms of counting infections, counting deaths, counting hospitalizations?
Well, those are the big three. And I think, the number of overall cases is a bit of the leading indicator for hospitalizations and deaths. And fortunately, as there are fewer people, people can get more intensive care. There are different treatments and hopefully more treatments coming. But our goal should be to prevent, as many infections, hospitalizations, and deaths as we can. But we should be looking at all three, I think.
When you look at a map, Doc, of the U.S., are there places you think that are vulnerable to a UK-type resurgence? Because surely we've got the coasts vaccinated, but the middle may be a problem.
Well, I was just in the American South, and there's not a lot of mask wearing, but I also know that those states have relatively low vaccination rates. So that combination of low mask wearing, low vaccination rates, and people thinking the pandemic is over or was overblown or something like that, that's a dangerous combination. And we know that the Delta variant is going to be spreading there pretty soon.
Dr. Sharfstein, late in the Padres game yesterday against the Cincinnati Reds, Myers of San Diego hit a ball down 4 feet inside the foul pole. He went to third base, there was a throwing error, and then he ran home with what's called a Little League home run. The roar of the crowd shocked me. That's how much we've been affected by this pandemic. Would you sit in that crowd? Outside, I would probably sit in a crowd like that. I think that, I'm vaccinated and vaccines are very effective and the virus doesn't transmit that much outside. But, people who aren't vaccinated, aren't wearing masks, or inside at the concession stands, they could pick up COVID, particularly the Delta variant. So I don't think that's such a safe environment necessarily for everyone, the bathrooms, other places, in the ballpark. So, it's just that we're not there at the point where we can stop thinking about the COVID pandemic. We should be, the end game. This is like the end of the game. We need the closer to come out, to take your baseball analogy, and pitch some strong innings at the end in order for us to really move past that. And that means really talking to people in your life, helping them get vaccinated. That's really, really important for us to put this in the W column. Dr. Sharfstein channeling the Baltimore Orioles there and their quality relief staff. Dr. Sharfstein, thank you so much for joining us today from Baltimore's Johns Hopkins University. Matt Miller, it is time for the obligatory Bitcoin talk. Bitcoin rolls over. Bloomberg reporting out of China that it's basically the Chinese government going further. How critical to you within the synthesis of this is a support at 30,000?
Well, the support at 30,000 is critical, and technicals, which I've never really thought too much of. Matt Winkler famously didn't think too much of technicals. They're really important in something like Bitcoin because there are very few fundamentals to trade on. But I'm not sure how much China's crackdown on mining has to do with this. It also has a lot to do with the reflation, deflation. And keep in mind that the Chinese... Yeah, sure. The Chinese people are still huge buyers and huge users of Bitcoin. And if you look at all of the unicorn startups that we've been reporting on recently, they're all out of China. They're all based in Hong Kong.
Yeah. Lisa, I was sitting on Fifth Avenue having the obligatory cigar, and there was the Porsche that pulled out onto Fifth Avenue, and I thought of Matt Miller.
Matt Miller.
Responsiveness.
Obligatory Porsches.
Responsiveness. What, the price goes up and you buy more? Is that the responsiveness
No, they're
of Matt
more
Miller?
responsive cars. That's why they're better. They're more responsive. And now they're sourcing their own batteries near Stuttgart. So they'll be even more responsive than any central bank.
See the enthusiasm, Lisa, we get out of Miller when we
car
start
talk.
with obligatory Bitcoin and obligatory car talk.
Yeah, he just lights up.
It's like a different person.
Well, I mean, I would too if you bought me a Porsche.
Matt, did you survive Father's Day?
I survived Father's Day. Actually, for the first time in my life, my dad called me to wish me a happy Father's Day. So
That's the best news of
very
the day.
cool.
That is.
Very, very cool.
Yeah.
Very, very cool.
Well, happy Father's Day to both of you. It was a lovely day. Nice and sweltering. Tom Keene, you buying Bitcoin?
God, no, I'm not buying. Well, I don't know. You know, I'm looking for an entry point on Amazon. It's Prime Day. I'm primed.
Yeah. So is Afterthought.
I might buy a fractional share.
Yeah.
Matt Miller, thank you for joining us in this hour. Greatly appreciated. From Berlin, coming up on the Fed speaking this week, we got the perfect guest to start strong. In the 7 o'clock, Ben Emmons will join us, some Medley Global Advisors. On radio and TV, please stay with us. The 10-year yield, 1.43%.
We still see there being more to go in this restart narrative.
It's still being affected by concerns about COVID.
The biggest risk for me is that I underestimate how much inflation is going up.
The Fed doesn't know either when this transitory notion is going to go away.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. We welcome you on a day of turmoil in the markets. There's no other way to put it. Equities, bonds, currencies, commodities all have a dynamic story to tell. And all of this around Fed speak this week. It's a theme this hour. Ben Emmons to join us in moments. Lisa Abramowicz, let's just get down to it. First, do no harm. What does the Fed not want to say this week?
I don't know. I mean, honestly, I don't know what message they want to send. I don't know. Maybe they're doing a victory lap because, frankly, they've injected a little bit of caution into markets without creating turmoil dramatically so anyway. And isn't this what they wanted in order to avoid some sort of bubble or asset price fears, Tom?
Last week, my data checks were lousy as voted on by the senior management of Bloomberg. So Kaylee Lines joins us this morning to straighten me out. Kaylee, thank you so much for being with us. I thought the early morning hours in London were very valuable talking about the markets. And the center tendency for me is Steve Major and the team at HSBC still predict a 1% 10-year yield.
Got a little more ways to go down to 1%, Tom. We're looking at a 143 this morning. But I would say the picture right now at 7:30 Eastern time looks a lot different than it did when I came into the office around 3 a.m.
Really
then futures were lower. We had a flatter curve. Again, the 30-year yield, I should say, broke below 2%. Now the story looking very different. We are back above that level on the 30-year. We have a steeper curve and futures right around the highs of the session, Tom.
And Lisa, I want to get to this before you do the brief. And to me, it's just real simple here. It's the wall of money that's out there. Tony Crescenzi of PIMCO addressed that. It's truly trillions of dollars, and the when of that moving is the arch debate, isn't it?
Well, the idea here of where is it moving to, right? If we've got the ball of money that was rolling around China, it's now rolling around the entire globe. And we have all of this money. At what point do people move into risk assets? At what point do people actually just buy stuff and buy experiences, Tom? And we are starting to see that, but perhaps not as much as people expect.
If you're confused, well, join the crowd. I'm confused too. And Ben Emmons with us in a moment. moment. Let's do the data right now, Kaylee Lines. I'll pick the equity market because it's easier. Futures up 19, Dow Futures up 200. The VIX goes out to 20.19. Kaylee, what do you see in the spread market and in bonds?
Well, in bonds, I'm looking at a 10-year yield that is going nowhere from Friday's price, Tom. 1.43% right now on the 10-year yield after it was pretty substantially lower earlier. We were right around 136 at one point around session lows. And of course, that 30-year yield, the longer end, has been really getting a bid over the past several days. And that is not continuing today, Tom. We get a steeper curve, not a flatter one.
The 10-year real yield, that's important to a lot of our viewers and listeners, negative 0.81% on that real yield. Again, we'll dive into that in a moment. Right now, I think on a Monday, it's 50-50. Let's get briefed.
All right, it's a 50-50. We're going to go 50% yes. Let's get a brief. You know, Tom, you asked one of the key questions. What message does the Fed want to be sending? Perhaps we get some sense of that. Today, we get a slew of Fed speak, including James Bullard. Jim Bullard had a very hawkish tone on Friday. Will he continue with that message? John Williams of the New York Fed and Robert Kaplan of Dallas. Really, the question to me is how much dispersion is there among the different members on the Federal Reserve? Is there a consensus forming that inflation really is a significant concern and should outweigh letting the market run hot enough to get employment to a full enough picture yet to be determined? 1:45 p.m., President Biden is meeting with financial regulators. They're going to be talking about climate change and how this could affect the financial system. What kind of existential risk is being posed here?
Wait a minute. Is he going to talk to Gensler about meme? About GameStop?
Presumably, he will go beyond the purview of just global warming, but it's being headlined as that being the major focus. But yes, I would guess that he would be talking about a whole host of issues that are a threat to the financial system right now, especially due to all of that cash sloshing around, some people getting concerned. We have an excess, a glut of cash. What happens if that reverses suddenly and we get a shortage of cash? How do these flows really get translated in an unprecedented time? And also today we have, of course, the Bloomberg Qatar Economic Forum, a host of really key speakers, Ray Dalio, Larry Summers, Stephen Schwartzman, you name it, they are speaking. My question is, how do they look at inflation down the road? How do they look at the Fed's reaction function? And is cash still trash, as Ray Dalio famously said a little bit more than a year ago? Is there a sense we are in a new regime after printing all this cash, or are people backing off that, Tom?
As Kaylee Line said, red on the screen earlier, now green on the screen. S&P futures, S&P up 20 points. Ben Emmons was booked. We said, yeah, okay, great. 7A slot. It's wonderful to have Ben Emmons with us on this Monday. And then things blew up on Friday. So this is a genius booking of Benjamin Emmons and Medley Global Advisors with an important research note over the weekend. What'd you write?
Yeah, Tom, I was looking at the dynamic of the curve on Friday, and it speaks to that you get guidance actually through the dot plot, which was different than in 2013 when the Fed actually didn't do that and yields jumped. And so the opposite effect then happens on the long end of the yield curve that says, okay, maybe these future rate hikes are sufficient to control inflation around that 2%. So the market is given some credibility on that front to the Fed. But there's also a lot of technicals at work, as you probably have talked about with Tony. You know, this positioning that took place prior to all this flattening that we're seeing was really predicated on that markets were expecting a growth.
Folks, this is what we do. When we invented surveillance, this was a couple months ago, when we invented surveillance, we said what we want to do is get a short-term guy like Crescenzi on the show and then get a long-term guy like Emmons as well. Parachute into Crescenzi's market. Long-term people like you and, frankly, Jerome Powell, what do they think of trillions of dollars in the Crescenzi space, overnight repo, and the rest of it?
So it's not only substantial, but it will continue to compress short-term interest rates over time. As much as you want to communicate that you're going to raise rates, you cannot really expect this two-year yield to jump all the way out to this projected rate that the Fed has put out. I think it's more like a very slow normalization. And markets know this, actually, because we experienced this in 2014, too, when we went really slowly with the two-year yield over time. I think that's what you can expect. Whereas on the long end of the yield curve, it's this dynamic, I think, of a technical positioning and the fact that, you know, maybe these rate hikes are sufficient to keep inflation in the future under control.
All right, so if it is technical, are we almost through with the technicality, Ben? Are we moving into a period where perhaps long end rates can possibly rise on the prospect of less Fed accommodation?
I think, Lisa, that the rates communicated this time compared to 2013 is that we were missing guidance on rates in 2013. And if we have this idea now that, okay, it's going to go that trajectory, you take out some of that risk premium out of the long end. At the same time, to your point, probably there's some scope for rise in long-term rates as new data comes in and surprises still to the upside. Let's face it, we have an economy that's really strong. It's not normal to have rates at these low levels. It's, as we talked about a few weeks ago, it looks like dislocated. So I would think the next payroll report, even the core PCE data that comes out this week, surprises to the upside, probably a catalyst for rates to somewhat normalize again back to inside the rates where we came from.
Ben, did we already get the taper tantrum? Was that what March was?
Maybe, Kaylee, but there's a definition about this taper tantrum. In 2013, it was really a communication that confused markets and led to this repositioning on, okay, we didn't really expect you to go this fast with ending QE and then moving to rate hikes maybe in the future. So in that respect, the Fed, I think, has done a really good job controlling that aspect. But I think what the markets were not expecting last week was to see this dot plot shift. And I think what really happened on Friday was just completely recalibrating what we saw in March, where the expectations for rate hikes were the same as they are now today, with now the difference that the markets understand what the Fed is potentially planning to do, including working towards this start of the tapering process.
Well, Ben, to Kaylee's point, though, isn't it surprising that you're not seeing a bigger wobble in risk assets, given the fact that people are starting to think about tapering sooner?
I think there's two things going on, Lisa, because, yes, tapering means, removal of accommodation over time. But we also have to discount the fact that the Fed is still super accommodative. Right? We will continue to buy $120 billion a month, which, by the way, larger than in 2013 when it was like $85 billion or so. So we're going to continue on that pace for at least a number of months, if not longer, until that tapering actually happens, maybe presumably in 2022. So you're looking at a balance sheet that's going to extend beyond $9 trillion.
Very quickly here, we're out of time, Ben, but very quickly here, what do you need to hear from Fed officials in the coming days, including today?
I think you want to hear that what they've put out as projections is what we call a bullish forecast. They're looking at the economy will be protected here against this surge of inflation. And this forecast that they put out on the dot plot has always been considered to be an individual, that's re-emphasized, right? They are still at the starting phase of considering future normalization.
Ben Emmons, thank you so much with Medley Global Advisors this morning. Lisa, I look at the bond dynamics. What's the part of the bond market, Lisa, you look at right now within the 47 spread you look at and the actual nominal and real yields? What matters to Lisa Abramowicz?
The belly of the curve. That's where people were looking in terms of whether there was potentially value there. And I know you're looking down, Tom, but that's not my implication. I'm just saying that people were looking at the idea that 5-year yields climbed to the degree that they did disproportionately, and whether that was perhaps a place of value. I think that is an interesting conundrum in the bond market.
Kaylee, you'd like to jump in here and insult me as well?
I would never.
Kaylee. Oh, you'd love to.
Don't let his insecurities get into your head. Go ahead, Kaylee.
I would never insult you, Tom, but Lisa's watching the belly of the curve. I'm watching the longer end, and of course the dynamics between the two. Is the flattener over? Was yesterday or last week's really dramatic action all we're going to see with the steepener coming in today? I wonder how much longer that trade is actually going to persist.
Okay. How'd she get on the show, Kaylee?
Someone let me in. I don't know. Take it up with management.
Thank you I will. Thank you so much, Kaylee, for joining us. And we look forward to the coming minutes as we flatten her and steepen her and the rest of it as well. These are serious conversations, folks, and seriously, our economic team is really steeled for the Fed coverage this week. So I believe John Williams is on the docket today, and that's always important. The gentleman who gave us the gift of our star, it keeps on giving. The VIX 20.29, futures up 17, Dow Futures up 185, NASDAQ up 0.4%. Stay with us on radio and television. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. National Security Advisor Jake Sullivan says the U.S. is working on additional sanctions against Russia for the poisoning of opposition leader Alexei Navalny. President Biden said he raised Navalny's case with Russian leader Vladimir Putin during their summit last week and made it clear that Russia would face consequences if Navalny died in prison. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness nearly $21 billion of annual R&D spending to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. The Tokyo Olympics will limit the number of spectators to 10,000 people per venue to reduce the risk of the world's biggest sporting games turning into a super spreader event. The organizing committee chief says the number will be set at either 10,000 or 50% of venue capacity, whichever is smaller. And President Biden's administration has rejected Venezuelan leader Nicolas Maduro's call for relief from U.S. sanctions, saying he needs to do more towards restoring democracy. Venezuela was a target of crippling American sanctions under former President Trump. Maduro reached out to Biden in a Bloomberg interview last week, calling on him to lift sanctions and normalize relations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What is more surprising is the degree to which the Fed is linking themselves to realized inflation data that they themselves are suggesting will be transitory. To me, this isn't really a change in their monetary policy strategy or reaction function. This is actually an execution of that strategy to focus on realized data at the expense of forecasted data.
Matthew Hornbach of Morgan Stanley there, among other voices. I really can tell you, folks, it is a market day out there. There's no question about it. Red on the screen earlier when Kaylee Lines entered the door, and we've really seen a very nice advance. Kaylee, what's the why for the green on the screen that we have?
I don't know. It started at the European Open, Tom. The European Open was down about 0.6% for the stock 600, and then you saw that bid coming in, and with it we saw futures now right around session highs climbing, and that was after a really ugly Asian session. So I guess the question is, was Asia playing catch up to what we saw here in the U.S. on Friday? And now we're seeing some of those reflation bets, maybe a little bit of dip buying happening, Tom.
And Lisa, in the short space, I mean, LIBOR OIS is really not much of this, but that overnight repo surge that we saw over the last week has just been extraordinary. It's really unprecedented.
I mean, this is the conundrum right now. We have so much cash in the system. Banks don't want companies' deposits. They're actually going to charge them for it. What happens with all of this? I mean, how much does this just suppress all bond yields and keep risk assets elevated? Can this continue indefinitely? Or at what point does it have to stop?
Two things off the chart. Oil this morning still rounded up, $74 on Brent crude, 73.56. And I really want to note new weakness in Turkish lira, maybe not out to a true record, but at 8.78, I would suggest with the velocity of the move, we're on the 8 lira to the dollar watch. I've never said that before. Emily Wilkins with us out of Washington. And buried beneath the fold and beneath the second fold and beneath the third fold is the strange thing of infrastructure, which we've been focused on. I mean, Emily, it's not Iran. It's not Biden back from the big trip to Europe. It's not the rest of it. It's not even the Washington Nationals relief pitching. What's happened to infrastructure? On this Monday, what gets done on infrastructure?
So look, there's Monday, and then at the end of the week, there's Friday. And after Friday, the Senate and the House take off for that July 4th recess. And that means that, once again, the pressure is on President Biden to make a decision here about how the Democrats go forward. 21 senators, bipartisan group, have offered a $1 trillion infrastructure plan. Now, the details still aren't clear on how to pay for this. They've talked about a gas tax. The White House has said no way on that. And so there's still a bit of a question about working out the details on that particular thing. But there is an interest from the White House in potentially going forward with this bipartisan deal. The question then becomes, how do Democrats move forward? Do they wind up two-tracking the bipartisan deal and a larger infrastructure package? How do they get senators like Bernie Sanders on board, who's not happy with that bipartisan agreement because it doesn't have enough for climate change and other priorities? So lots of questions here, but they all start with answering that one: does President Biden want to shake hands and make an agreement with these bipartisan senators and get a bipartisan bill done?
Emily, let's talk numbers, especially as we talk about the Fed potentially tapering its stimulus. President Biden is reviewing a $579 billion plan. This is the bipartisan plan. It is a far cry from the $1.2 or the $1.9 trillion plans previously proposed. Is this what we're looking at now, the more likely situation where we see a sub-$600 billion plan passed and then a battle into other priorities?
Well, here's the thing, Lisa. Even if they do wind up saying, yes, let's go ahead with that $597 billion bill, Democrats are still going to want to pass another trillion-plus legislation. And that's going to include things such as the child care, child tax credit, expansion of Medicare, potentially things like preschool. And so the fact of the matter is that even if they pass this smaller bill in a bipartisan manner, Democrats are going to want more.
Well, Emily, they're going to want more. Whether they will get more is another story. And I'm talking about the Fed in tandem with the fiscal spending, because people are starting to worry about inflation. And it's not just monetary policy members. It's also the folks down in Washington, D.C. It's also people who are going to the gas station and seeing more in terms of the price at the pump. At what point has President Biden run out of room for his most ambitious spending plans as people look at an economy that's getting back on track?
When you talk to Democrats and you talk to them about inflation, they'll pretty quickly pivot the topic to saying, hey, we got elected. The American people elected Democrats. We control the House. We control the Senate. We control the White House. And they want to get something big done before those 2022 midterms. I mean, I think that, particularly for progressive Democrats, that's where their eye is on, perhaps a little bit more so than inflation. They feel that if they can get something big done, they stand a chance to win in a midterm election that is heavily favored toward the Republicans. And that's something that they're thinking about very much. I'd say even a little more so than inflation at this point, particularly as you hear individuals like Treasury Secretary Janet Yellen still downplay the potential risks from inflation.
Well, Emily, yes, the Democrats do control the House, but not by an overwhelming margin. And you speak of progressives wanting to spend more. Frankly, are Democrats going to be on board with a smaller bipartisan $579 billion proposal?
Lisa, that is the trillion-dollar question here. I mean, a number of progressive Democrats, including Senator Bernie Sanders, have already come out saying that they're not on board with this bipartisan plan. Now, that could potentially change if they come to some agreement saying, look, go ahead and vote for this bipartisan deal, and we promise you, we guarantee you we're going to be passing another larger reconciliation bill. That's what a number of progressives are looking for right now. But you're very right in calling out the fact that the House has a very slim majority. Democrats could only lose 4 individuals there before they're not going to be able to pass anything. So as you're looking at your Joe Manchins and your Kirsten Sinema's, you also have to keep an eye on your AOCs as well as your moderate Democrats, many of them who are going to be facing really, really tough re-elections.
Sounds like a new quote for gridlock. Emily Wilkins, thank you so much. In Washington, an eventful week to be had. We'll have full coverage here through the week as well. Lisa, you know, we talked to Matt Miller, and I guess he went out and sold it all. Bitcoin really has lost the bid under 32,000. I'm going to call that not a quote of the moment. Really a 29,000 quote would be far more important. But nevertheless, Bitcoin can't find a bid today.
Well, what Matt said was interesting, that it was more a risk-off tone, perhaps the Fed taking accommodation out of the market, a move away from this regime of ever printing money and expanding the monetary system, that was more the reason why there's been this sell-off in Bitcoin. If that's the case, Tom, why are we not seeing a commensurate decline in other risk assets? Why is it so isolated to Bitcoin? But that's interesting to me. How is that possible if Bitcoin is considered the marginal risk-taking measure, and you've got the likes?
It's considered that by people that support Bitcoin. I don't hear that from people that question Bitcoin's veracity.
Well, but then you've got the likes of Troy Gajewski saying this is the key macro bet and the key potential for the outperformer or the underperformer in your portfolio. And there is, of course, also a degree of regulatory scrutiny, particularly from China. I don't know.
And Kaylee, what'd you learn about Bitcoin? I mean, Matt Miller wanted to do one of those hours all on Bitcoin, didn't he?
Oh, he did. That would be his choice. 5 a.m., talk about Bitcoin for an hour straight. I would say keep an eye on the technicals, Tom. Death Cross. Just watch it.
Oh, listen to us.
Bitcoin
the Death Cross.
And Death
Coming
Cross.
up, Kaylee Lines on the Death Cross.
I think a little piece of me just died.
Gene will join us. Well, stay with us. Futures up 13. Bloomberg Surveillance, good morning, everyone, on economics, finance, investment, and yes, of trillions of dollars of cash sitting out there and what it means for the Fed optionality out the next couple of years. Tom Keene and Lisa Abramowicz, Kaylee Lines in for John Ferro today, in for Romaine Bostic, in for Taylor Riggs, and Matt Miller and 47 other people as well. We'll get to Kaylee in a moment. Lisa Abramowicz, I look at where the markets are today. It's not a normal Monday, is it?
No, I think people are trying to understand the Fed's reaction function, to use your phrase. And honestly, this dissonance between lower yields indicating slower growth, yet a bid into risk assets that I just am not understanding the permanence of, Tom, heading into a choppy rest of the year.
I can't convey the surprise that's out there. George Saravelis at Deutsche Bank writing about R-starred. John Williams will be a speaker today, the inventor of all that with his Kasten group at San Francisco Fed years ago, now at the New York Fed. Kaylee Lines is with us on the equity markets and on a company from Sioux Falls, South Dakota, Raven Industries. Kaylee.
Yeah, a little M&A in the ag tech space this morning, Tom. Raven is getting bought by CNH Industrial for $58 a share. And in pre-market trading, it is trading almost at that level right now, $57.69, up about 49%. Of course, that price tag was a 50% premium to Friday's close. Another stock surging in early hours is Torchlight Energy. This is one of the new favorites of meme traders on Reddit. Once again, getting touted on Wall Street Bets as a potential short squeeze. I'm doing my best Romaine Bostic impression. That stock is up around 40%. AMC getting a little bit of a bid as well. And CureVac, some dip buying for a second day. Remember, it fell 38% last Thursday after that poor efficacy data from its COVID-19 vaccine trial. It was however, bought on Friday. It's being bought again this morning. And we were just discussing Bitcoin, blame the Fed, maybe pulling some liquidity out of the market eventually, blame China. Whatever it is, Bitcoin is moving lower. And as a result, it is dragging on stocks tied to Bitcoin in pre-market trading. Marathon Digital, MicroStrategy, Riot Blockchain, all down more than 8% at this point in early hours. Coinbase, of course, the cryptocurrency exchange, also down by about 3%, Tom.
Thank you so much. Right now, a very cogent note. Everybody publishing over the weekend and the follow-on on Fridays, challenges within the market and the oddity in the Asia opening today. And then over we are now to futures up 14. They're up a little more earlier. Gene Tenuso with us from Columbia Threadneedle. And Gene, I love it. And I'm going to pick up here and steal from Lisa. I'm really good at stealing ideas from Lisa Abramowicz, particularly on a Monday. And that is the dispersion of the Fed decisions to come. And you suggest that this is original uncertainty. Discuss the challenges these many Fed officials have.
Well, I think you're right, Tom. And if we look at those dots for 2023, the market was obsessed last week that the average Fed forecaster was predicting higher rates than we would have otherwise expected or previously expected in 2023. But that dispersion is exceptionally wide, including some Fed officials like James Bullard, who expect higher rates as early as next year. And I think what the market is trying to grapple with here is trying to figure out, is the Fed actually committed to average inflation targeting? Now, remember last year when this was introduced as a policy reaction function, they basically said we're not going to focus on short-term realized inflation. We're going to be focused more on long-term inflation expectations. And these bumps in the road, this noise, we're going to consider that transitory. And they kind of blinked and they said, no, actually, we're reacting now, or at least making an adjustment to our forecast based on short-term realized inflation. And I think the market is confused by that.
When you say they, it's really a view of a number of separate officials. This idea of disagreement on the Fed leading to elevated Fed decision uncertainty. How much is this being priced in? What are the market implications of this disagreement that we're seeing brewing on the FOMC?
Well, we're seeing the market bring forward those rate hike expectations. And actually the market for the first time in a while is probably pricing in a more aggressive forecast, a more upward forecast in interest rates than what the Fed itself is predicting. But I think if you're the Fed, as much as they do have disagreement and there is uncertainty, they have to be pretty happy with the financial market outcome, quite honestly. Because when we were talking, for the last several months, one of the biggest fears was a taper tantrum. And a taper tantrum where yields shoot higher and you see, imbalance in risk assets like stocks and credit spreads. And now as we look at where yields are, and as you talked about earlier, the long end has actually come lower, if anything. We've seen some inflation premium drain out of the market, and credit spreads are still exceptionally tight, and stocks are within spitting distance of all-time highs. So as much as they've communicated uncertainty and there's still a lot of unanswered questions, I actually think Fed officials are probably pretty happy with where financial markets are at this stage.
Gene, is a taper tantrum off the table?
No, I don't think so. It's just delayed at this stage because we still don't know, remember, Lisa, what is substantial further progress in the labor market. That's a key variable that they have defined and put in their statement. And that's something they need to define for the market over the next several months.
Gene, you talked about how tight credit spreads still are. I think 286 basis points or so for high yield. At what point do we get the read through and those start to widen out?
Well, look, we always look at three things when we look at credit spreads. We look at the fundamental environment, the technical backdrop, and valuations. What are you being paid? And valuations are the most challenging. And when high yield spreads are inside 3%, historically, that's not a very good time to get into the market. But the technical picture is still robust and fundamentals are as supportive as they could be. On the fundamental side, we're trying to look beyond the reopening bump and see what sustainable growth looks like. I think there could be, a little bit left in this carry trade, but I think it's pretty dicey to really load up the boat on high yield at this stage. We'd much prefer shorter maturities within the high yield space.
So elaborate on that. What do you put in a fixed income portfolio right now?
So we'd rather be diversified amongst shorter maturity, high yield securities, a mix of securitized products like mortgage and asset-backed securities that can benefit from the strong state of the consumer. And what we would not want to be exposed to would be things like longer maturity investment grade bonds where there's really no price upside at this stage in our view. And those sort of volatile components can really detract from return.
Gene, within all this is we got to make a decision. Is this the time to reallocate or is this the time to sit on your hands?
Well, I think the best thing you can do is stick to your rebalancing discipline. And this was something that we learned in early 2020 before the pandemic as well, which is even when interest rates are low, if your equity portfolio has appreciated to pretty high levels or your risk asset portfolio, rebalancing to whatever your neutral allocation is a pretty healthy thing to do. And typically when credit spreads are this expensive and equities are this high, an allocation to high quality fixed income is still beneficial. And it's something that will help you in the long run from a diversification standpoint.
Well, that's fine. I mean, we can diversify out as much as we want, but as Lisa's mentioned throughout the show today, you go back to the 60-40 model. In the bond market, I don't have a clue what's happened. I mean, Steve Major at HSBC and his team is telling me to load the boats on bonds.
Well, I don't think you can just look at the bond market and say low interest rates are a bond market problem. I mean, we really think low discount rates are going to be with us for a long time. They affect all financial assets. It affects credit and it affects equities. And it explains part of why we're seeing the elevated valuations we are elsewhere. I don't think it changes anything in terms of that discipline, whether you're neutral, be 60-40 or any other balance.
Gene, what's your biggest concern going forward if it isn't a taper tantrum, if it isn't perhaps inflation getting carried away because the Fed is going to step in? Where is the concern at this point?
Well, all the focus right now is on the tailwinds, Lisa, and those tailwinds come from fiscal. Those tailwinds come from the Fed. Those tailwinds come from reopening the economy with all this excitement. I'm a little bit worried about next year and the headwinds that start to come into place. I don't think fiscal is going to be as helpful next year, particularly if we're talking about higher taxes to pay for the infrastructure plans that were just being discussed. Monetary policy is going to be going the other way, likely with a taper in the beginning part of the year, and we'll really be exposed to whatever the underlying trend in growth is. And we really don't know what that is at this stage. So I think when tailwinds become headwinds and you're already expensive in the market, I just think you got to be a little bit careful out there.
Gene, thanks so much. Gene Sanuzzo with us today with Columbia Threadneedle. Kaylee Lyons, Lisa Abramowicz, and Tom Keene, thrilled you're with us this morning. Lisa, I'm going to go to the John Williams R-Start idea. Sarah Vellis writing this up for Deutsche Bank, and the wonderful tension between Sarah Vellis, more short-term at Deutsche Bank, and David Folkerts-Landau and his team, more long-term analysis at Deutsche Bank. And it just comes down to this idea of R-Start and its link into what economic growth will be. To me, that's the major focus.
Well, just in plain English, we just don't know where inflation is going, right? I mean, that's ultimately.
We also don't know where the economy's going.
Well, but that's key, right? We just don't know how this is going to extrapolate out into the future, whether the fiscal impulse will continue. I mean, honestly, we've been talking all of this time about potentially withdrawing monetary stimulus. But what are the implications of a much smaller fiscal spending package in Washington, D.C., which looks increasingly likely? Is that priced in? How much have we already moved back to the old regime that we're used to, Tom, which is slow growth, and now we've got more debt that will slow it further.
Kaylee, what research did you see over the weekend or into this morning that caught your eye?
I'm looking at oil, Tom. Francisco Blanche out of Bank of America calling for $100 a barrel next year because of the extent.
This?
Well, I'm telling you now, Tom.
Hell.
I had to build up to it.
Kaylee's hiding secrets from us. I mean, Francisco Blanche at 100, and I'm hearing about it right now.
Well, that's the call, Tom. Demand is going to outstrip supply is the basic thesis from Bank of America. And of course, this is where the Iran conversation comes into the forefront. We know those talks ended in Vienna without a deal after the 6th round. Are you going to need Iranian supply to come back onto the market to meet all of this demand we're seeing as the world reopens, Tom?
I think she's one-upping us.
With $100 barrel oil? I hope so. We need some one-upping this morning on this Monday morning. I think it's a great thing to bring up, the idea of, are we going to see higher oil prices, or are we going to see them go down as people basically reprice the reflation trade? Are these coherent trades, given what we're seeing in the bond market?
It's that lonely idea, Lisa. Chris Verone of Strategas talking about $80 as a target, and I would suggest nobody's really framed $80 yet. And then there's Kaylee Lyons showing us up this morning.
Triple digits.
Out at Francisco Blanche and 100.
He's not alone. There are other analysts as well.
Can this not happen again?
Just thumbs off.
I'm asking.
Kaylee, it's fabulous to have you. Happy Monday, and thank you.
Futures up 14, $100 a barrel. How do you spell her name? Kaylee?
Really, really, Tom? Happy Father's Day.
Yes.
With the First Word News, I'm Rishka Gupta. There's political chaos in Sweden after Prime Minister Stefan Löfven lost a confidence vote in Parliament. That toppled his minority coalition and leaves the leader with 1 week to decide whether to call snap elections. If Swedes are forced to head to the polls early, it would be the first time since 1958. Authorities in Hong Kong will shorten quarantine time to 7 days for fully vaccinated residents traveling from most places. They're also set to cut the requirement for non-residents who are vaccinated. These are the most significant moves yet to ease one of the strictest border curbs in the world. Other plans include lifting capacity restrictions at some restaurants and swimming pools. The board of Next Digital has reportedly agreed to suspend operations of the pro-democracy Apple daily newspaper in Hong Kong. The move comes after police there arrested top editors at the flagship newspaper of media tycoon Jimmy Lai, and national security officials froze its bank accounts. The board will apply to Hong Kong's Security Bureau to unfreeze the paper's assets and says it will decide on Friday whether to seize Apple's daily operations. European natural gas extended its unprecedented rally as supply curbs sent prices to their highest levels in nearly 13 years. The gains are fueling concerns about inflation. Gas is so scarce in Europe that some utilities have turned to burning more coal, a setback for those fighting against climate change. Israel's new foreign minister is set to travel to the United Arab Emirates next week. It'll be the first time ever to visit the Gulf country by a top Israeli diplomat. Foreign Minister Yair Lapid's visit comes after the two countries normalized relations last year in an agreement brokered by the Trump administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If we're going to believe in a positive structural outcome from this awful pandemic, is for that real yield to become far less negative. It can't stay here. This is not sending a very positive discount.
Patrick Garvey on the battle of inflation-adjusted yields there. Right now, the 10-year real yield and negative 0.81%. We welcome all of you on radio, on television. Lisa Abramowicz and Tom Keene. John Farrow's off today. We're thrilled that Kaylee Lyons could join us this morning. What we're trying to do on the markets is give you a cross-section of views across assets. Ira Jersey will be joining us, scheduled in a bit. And then Jane Foley at the last moment has come on board from Rabobank. Really pleased that Jane Foley could join us today. Right now, all of this market action dovetails into the banks. There has never been a crisis like this in the career of Gerard Cassidy. He's with RBC Capital Markets and joins us right now. He has seen this before, angst and hand-wringing. What does all this uproar, Jerry, mean for the big banks?
Tom, you're right. We've been through a number of different cycles, and each one has a different side to it. But this one is quite interesting because we've not seen this low rate environment persist for so long, particularly on the long end of the curve, with the likelihood of inflation heating up to levels possibly we haven't seen in over 25 years. So the industry right now is grappling with an excess amount of liquidity caused by the quantitative easing by the Federal Reserve. As you know, Tom, their balance sheet, the Fed's balance sheet now is over $8 trillion, and that's up from $4 trillion prior to the pandemic, and that's gone into the banking system, which is weighing on their margins along with this rate environment.
You know, I looked, Gerard, and we were talking about $34 lobster rolls as we were coming on with Gerard Cassidy of Portland, Maine. And I guess the question is, when you see a pullback in J.P. Morgan of 11% or other selected Cassidy stocks, is it time for Gerard Cassidy to load the lobster boat?
I think it is, Tom. In fact, this pullback is a great opportunity for investors to buy bank stocks, whether it's JP Morgan Chase or Bank America or any of the large regionals like a PNC or Truist. And you're right, Tom. If you believe that the U.S. economy is truly growing at 6 or 7% and throw in 3 or 4% for inflation, loan growth historically, Tom, going back to the 1940s, is correlated to nominal GDP growth. And loan growth hasn't shown up yet because of the liquidity of corporates and consumers. But over the next 12 months, we do expect to see loan growth with the growth in the economy the way it's projected today.
And Lisa, this is so important. A grizzled pro like Cassidy, who remembers when a lobster roll was $3.40. And Lisa, I'm sorry. The fact of the matter is he's looking out 12 months, not 12 hours.
Tom, I love that your priority right now is a lobster roll. I am right there with you, Gerard, talking about the liquidity beyond perhaps the beverage of your choice to accompany a lobster roll, but rather the liquidity in the financial system. You talk about extending loans, the idea that there's $3.9 trillion of cash, of reserves at the Federal Reserve versus pre-financial crisis of $46 billion on average, a complete magnitude change. What is the trajectory of getting that money into lending at the same time that people are drawing down their deposits and actually spending that cash, perhaps taking that cash out of the banks and into the economy?
No, that is the key metric, and you're very observant on the numbers. And I would suggest that that's what the banks want to do. The banks, as I try to remind myself and investors, banks are in the business to lend money. They want to lend money to qualified borrowers. And right now, the demand's not there. But as the liquidity is used up, and remember, the consumer has a number of benefits that are expiring in the fall. For example, if you're a student and you're deferred your loan payments, that expires in the fall. So I think you're going to find people are going to use up their stimulus payments. to help with their monthly cash flows and then revolve back onto credit cards, which we're starting to actually see. So maybe they are buying those lobster rolls, Tom, for $34.
Maybe people are buying lobster rolls. I wonder if companies are going to start buying other companies because, yes, the consumer balance sheet's looking pretty healthy, but companies have a lot of cash on hand as well. And Jamie Dimon last week in talking about the fact that, okay, yeah, trading isn't going to be as great, look to M&A as a driver. How much of a growth catalyst do you think M&A will be for these banks?
That's a real good question. And I think it will be a real driver because as corporates become more confident that the U.S. economy is out of the downturn that we experienced last year due to the pandemic, they will have more confidence to either build new plant or equipment or go out and buy a competitor to become more efficient. So we do see that as being one of the accelerants to loan growth, along with regular corporate loan demand. The building of all the new green initiatives, whether it's electric vehicles and other things, those too are really demanding corporate borrowing, and that too will pick up as, again, confidence comes back into this economy.
Gerard, how much does your buy banks call get threatened by a flattening yield curve, as many people now are looking at the consensus call as being that continuing?
No, that is a risk. I don't disagree with you whatsoever. If we're chatting here a year from now and the 10-year government bond yield is 110 basis points or 120 basis points, and there's more talk of the Fed raising short end, that would be a very challenging bank stock environment. I don't disagree with you.
Jerry, I don't care. What I care about, Gerard Cassidy, is a Connecticut or a Maine lobster roll. Are you going to go with a butter sauce, or in honor of your colleague in crime, are you going to go with a Mike mayonnaise like a good Maine guy?
You got to go with the butter sauce, Tom, with a nice IPA, with a nice IPA, and we'll call it a day.
Butter sauce. I never thought. Lisa, I'm absolutely shocked.
Really?
Yeah, that's
butter sauce
I
is
just figured
superior.
Cassidy was ice cold Mike mayonnaise and the whole thing.
Butter sauce is far superior.
Okay, thank you,
Yeah,
Gerard
there you
Cassidy.
go.
Thank you. I learned something finally today on the show. Gerard Cassidy of RBC Capital Markets, truly expert. We didn't even have time there to go for his single best buy within the sell side. And what I heard there, Lisa, is buy the banks.
Yeah, buy the dip here as they expect the acceleration in the economy to allow loan growth to pick up. We have not seen it yet, although he's saying on the margins, credit cards, I don't know, $3.9 trillion of cash parked with the Federal Reserve. To
Lisa,
me, that's shocking. I know you don't care.
Kaylee,
You're looking at
help
your
us
food
out
choices.
here. Cassidy's from Maine. I'm from up north. Lisa's from New York. You're the Southern girl. Help us out here. Butter sauce hot or cold mayonnaise lobster roll? Which
I don't even
is
know
it?
what you're talking about, Tom.
Oh, man.
It's just going right over my head.
Literally should be an evergreen comment.
This
on
is like
Bloomberg
having
surveillance.
Ferro on here. It's
I don't even know what you're talking about, Tom.
All I know is, generally speaking, this conversation has made me hungry. I don't know if for a lobster roll with butter sauce or with mayonnaise or maybe something else entirely.
I can see I'm going to be out $34 to miss lines here at some point as well. Folks, this is actually a really big debate, as we launch into the summer season. Do you have a cold, crunchy lobster mayonnaise, or do you go the Abramowicz way with a butter sauce?
Savory with a cold IPA.
Connecticut with a cold IPA.
It is still not yet 8 a.m. Eastern time. Just throwing that out there.
It's 5 o'clock somewhere.
Exactly.
AM or PM?
Doesn't matter.
God, keep her on. Who's this Ferrell guy? Don't bring him in. Keep Kaylee here. Make it work out. Futures up 19. Dow Futures up 213. A little bit of lift. BitDog. Oh, I can't quote BitDog. It's so painful.
It bit you. Sorry, I can't.
Public's hype over inflation had gotten too high. The Fed got spooked.
We still see there being more to go in this restart narrative.
We have an economy that's really strong. It's not normal to have rates at these low levels.
The Fed has to be very careful about its communications, not just verbal communications, but all types of communications.
I think what the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Partitioning a divided Federal Reserve. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, Bloomberg Television. Tom Keene, Lisa Abramowicz, Kaylee Lyons in for John Ferro. I am struck by the stasis that has overtaken the bond market as people reassess the Fed's message last week and look ahead, Tom, honestly, to what the economic outlook really is, given the fact that we are reopening and yet the Fed is concerned about inflation.
End of June here and into the end of the second quarter, and it is an unusual uncertainty. And Lisa, I would just say you've got to be riveted on every Fed speaker today as they recalibrate and calm a market.
Yeah, Jim Bullard, I don't know how calming he's going to be. He wasn't very calming on Friday when he spoke with CNBC, talking about how he would like to raise rates by the end of next year. Does this mean that the Fed could potentially taper its entire $120 billion monthly purchase to zero in 6 months? Tom, that is not being priced into the market right now.
I don't see it priced in the shift here in the market this morning. Kaylee Lyons, you've been living this morning. When I was looking at Kaylee Lyons' time, it was red on the screen, and we've really turned it around, haven't we?
Yeah, it was an uglier picture at 3 a.m. Usually the picture is a bit uglier at 3 a.m. because it is 3 a.m. But yes, Tom, it was a red day for the equity market, and you were seeing that bid into the longer end of the curve. A similar story to what we had at the tail end of last week. And now the story is changing. Futures up 0.4% on S&P E-minis, and we are going nowhere in the Treasury market. The 10-year yield just sitting just shy of 1.44%, Tom.
Lisa, Lyons crushed us last hour with their knowledge on Francisco Blanch at Merrill. I'm sorry. I mean, $100 oil, Lisa, that changes the dialogue.
Well, do you know that a number of oil majors have actually predicted the same thing, that they don't see the increase in supply that could offset the demand?
$100 a barrel?
Yes, there has been an increasing number of calls like that. They are not outliers entirely over at Bank of America. This idea here that you're seeing discipline, including from the swing producers over in the shale patch. They have not increased production despite the increase in prices so far, Tom. And this raises questions about the elasticity of supply.
There we go.
There you go. That's
Today's
just for you.
Word. Yeah, the Tang Mimosa this morning has elasticity as well. Futures up 16, Dow Futures up 190. The VIX, let's remind ourselves, 15, 16, and with the angst of Friday out well over 20, 20.32 right now on the VIX. In the yield space, 1.44%, 10-year yield. What a round trip that has been. And the 30-year bond, as Kaylee mentioned, was south of 2, now at 2.03%. Brent, $74 a barrel, rounded up. We can do that. Gold, $17.82 the ounce. Bitcoin, I refuse to quote under 32,000, not to upset Matt Miller, 32,400 now on the esteemed coin. We need to get our heads straight. Michael Kushner is going to do that right now with Morgan Stanley. Decades of experience and Chief Investment Officer of Global Fixed Income. Michael, an open question on a Monday. Have you ever seen a market like this?
It is very unusual from multiple perspectives. And we saw this massive curve twist. 10-year yields didn't actually move all that much from where we were 10 days ago. But the 5-year part of the yield curve, the 30-year part of the yield curve, we had a 25-plus basis point swing, which is very anomalous. Probably haven't seen this in over 10 years. So, yes, there's been a massive rethink about the path of monetary policy. But what's interesting is that the long-term targets, the long-term endpoints haven't changed all that much, which is the interesting bit.
Michael, I want to go pro question for the Greeks right now, the Greek letters right now, and part of that's gamma, convexity, or acceleration. For the pros listening and watching this morning, are you worried about suddenness or accelerative tendencies within fixed income?
Well, I think that's part of the movements we saw last week. We're positioning, curve steepening trades, Fed not moving anything for a long time, low volatility over the summer. The Fed wasn't going to really address tapering or changes in rates till the fall, till after Jackson Hole, the September meeting, and suddenly that whole narrative changed. So whatever you thought was going to happen over the summer has become a lot more risky. So yes, all those things have become difficult.
Michael, Tom asked me a question. What is the message the Fed members want to give to markets this week with all of the Fed speak, from Williams to Bullard and onward? What is the message, or are they happy with the disagreements that are being reflected in a little bit more uncertainty in markets?
I don't think they're necessarily happy about it, but it reflects the diversity of opinions which exist both within the Fed, within the academic economic community, within the analyst community on Wall Street. If you look at the FOMC, I think there's 5 members who still see no rate hikes in 2023, and 5 who see 4+ rate hikes in 2023. That's a pretty different opinion about how things are likely to proceed. And I think that given the rise of inflation, hawks are more willing to show their hands about, yes, this is potentially problematic, but the differences of opinion have not been settled.
Well, and of course, to the hawks, it is basically them saying, hey, we're not actually going to let inflation in the economy run quite as hot as maybe some in the market had anticipated. What is the actual read-through in fixed income if that is indeed the case, if they are actually going to keep a lid on inflationary pressures?
Well, I think we're seeing it already with the long end of the yield curve. 30-year Treasuries falling pretty sharply and staying or hovering around this 2% level, which is remarkable given how strong the economy is, how high inflation has risen, and yet the market now seems to have this confidence that the Fed will pull the reins in such that inflation expectations will not exceed the current levels in their long-term forecasts or targets.
Michael, do you think that we've entered a market that is no longer range-bound, but that gets chop, that actually can be identified as up or down?
I think we are moving into we are in a more two-way market, and we've been in a bull market since the end of March. Yields peaked at the end of March, and since then, Q2 has been a bull market in fixed income. High yields done well, spreads have tightened a little bit, IG's done well, and yields are lower. It's been a great quarter for fixed income. Not surprising, equities have had a bit of struggle and gone kind of sideways in many sense in Q2. But this scenario of worry about the future, that the Fed is not going to allow the economy to run away, that maybe this whole flexible average inflation targeting thing may be over, in the sense that the rise in inflation in 2021 will be sufficiently high to take average look-back inflation above 2% such that they can begin hiking rates next year. All to be decided in the next 6 months, I think.
Michael, how is your world linked into either real economic growth or nominal economic growth? And I link it through, folks, sort of a spider web of all these things we talk about, maybe back to a summation of R-star. Thank you, John Williams, speaking today. But then when I go beyond R-star, back to potential GDP or actual GDP that we're going to see, how does that filter into the Cushman world?
Well, I think the concept of R-star, very difficult to measure, difficult to understand exactly where we are, but it's a very important concept of the trend growth of the economy and the level of real interest rates which generate strong growth or weak growth, and the concept of secular stagnation, which we've been in for a long time, that Larry Summers promulgated as a function of this declining R-star, excess savings in the world. So the question is, going forward, is the fiscal expansion, which has been offsetting the rise in private sector savings, corporate and household, the last 6 months, a year or so since the pandemic started, will that money be spent in the private sector? If the private sector will spend that money, then R-star can rise, real growth will be stronger, real bond yields, nominal bond yields will be higher in 2022, 2023. If, however, and there's some evidence, I think the Fed has done research on this, that after previous pandemics in history, R-star tends to fall for long periods of time, and people don't spend all the money in accumulated savings they've acquired because they're worried about the future. How this breaks out in the next couple of quarters will be important to decide how this plays out.
And is this the peak, Michael? Are we peaking now in the second quarter?
In peak of growth or peak of
growth?
Peak of what? Growth. I think that's one of the reasons why bonds have done well in the Q2. People believe that growth peaked, inflation peaked, and will fall. The question is, how far will they fall? Right now, we're pretty optimistic the growth will remain strong into 2022, and inflation is not coming down significantly from the trend it's been in, but it will fall a lot from where we currently are today. But that's tend to be quite bullish for fixed income. We just thought yields might get a little higher before they started falling back down to these levels.
Well, thank you so much. Michael Cushman with us with Morgan Stanley. Interesting to dovetail his thoughts with what Michael Wilson is doing on the equity side. Futures, I'm going to call a bid to it. I mean, we really haven't broken out to a higher level. Nevertheless, off of Monday, a bounce. Dow Futures up 195 points as well. Lisa, I've got to go to the real yield. We haven't talked about that. And folks, this is the nominal yield minus the inflation expectation out to the residual, which is the inflation-adjusted yield. Which of those three parts, Lisa, are you focused on?
The idea here is that people are expecting the Fed to move away from buying bonds, and so they aren't going to suppress yields as much. You're seeing the real yield go up perhaps a little bit more in terms of the term premium. I, though, find the move rather muted. honestly, the fact that we still have a negative 0.8% yield in real terms on the 10-year indicates a great degree of accommodation and pretty tepid expectations for inflation and a sell-off in the future, Tom. I'm looking at that and thinking a lot of people are skeptical of just how hawkish the Fed really is.
We're going to see, Kayla, your observation right now as we go into the Fed speak.
My observation, Tom, is that you're not seeing the outperformance from tech like we saw last week. We saw that unwinding of the reflation trade in the equity market with the NASDAQ 100 outperforming. That was the case earlier on in the session, and now we're starting to see it roll over just a touch. NASDAQ 100 futures only up about 0.25%, and that compares with S&P 500 futures up about 0.4, Tom. So maybe we're seeing that reflation rotation rotating back.
Reflation, rotation, deflation, stagflation.
You gotta be gifted.
It's going to
like
be
well.
it's a nursery rhyme.
Lisa, she didn't beat us over the head that we missed $100 oil from Francisco Blonde.
So just to put this into perspective, we've heard other $100 a barrel oil predictions from Trafigura Group, and Goldman Sachs, but this is probably the clearest call yet. The idea here, we're all going out, we're flying around, we're traveling in our cars, we're moving around, and you're not having the shale producers come back online.
But
That's a big deal.
Yeah, a couple things going on here. Jane Foley to join us on foreign exchange. Really looking for that from Rabobank. And we begin the Bloomberg Forum, the Qatar Economic Forum, with the gentleman from South Africa, Cyril Ramaphosa, will be speaking in a moment. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. National Security Advisor Jake Sullivan says the U.S. is working on additional sanctions against Russia for the poisoning of opposition leader Alexei Navalny. President Biden said he raised Navalny's case with Russian leader Vladimir Putin during their summit last week and made it clear that Russia would face consequences if Navalny died in prison. Spain's Prime Minister says he plans to pardon 9 Catalan separatists who were put in jail for their role in the illegal independence referendum of 2017. The leader says he'll recommend that his cabinet approve the pardons when it meets tomorrow. A backlash is expected from conservatives who are opposed to any kind of reconciliation with the separatists. The two main contenders for next year's French presidential race both fared worse than expected in the first round of the country's regional election. Marine Le Pen's national rally got 19%, almost 10 points behind her score in the last election, with President Macron's party taking 11%. Turnout, estimated at 32%, was at an all-time low. One recent survey showed many citizens didn't even know what the elections were for. The Tokyo Olympics will limit the number of spectators to 10,000 people per venue to reduce the risk of the world's biggest sporting games turning into a super spreader event. The organizing committee chief says the number will be set at either 10,000 or 50% of venue capacity, whichever is smaller. UK Prime Minister Boris Johnson wants the UK to become a science superpower. The aim is to harness nearly $21 billion of annual R&D spending to find solutions for the public good. The new Office for Science and Technology Strategy will be headed up by the government's Chief Scientific Advisor, Patrick Vallance. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What we're keeping a close eye on is inflation expectations. If they really start to become unmoored here, people really do start to expect higher and higher inflation going forward, then that does become a little bit of concern. We are in kind of uncharted territory right now, not only with what's going on with the pandemic, but as well as the way the economy is responding to that.
Jay Bryson of Wells Fargo there with important comments, many different opinions about where we are. One of the great joys of where we are, Lisa Abramowicz and Kaylee Lines with us this morning on radio, on television. Thank you for being with us. Eventful markets with a not so much a new lift, but a sustained lift in the markets. Futures up 19, Dow Futures up 205 as well. Is trying to speak to authorities and the complexities of bonds. Anybody who's waded through Fibonacci knows there's a lot of mathematics going on here, a lot of dynamics. Tony Crescenzi earlier with us from PIMCO, and now a true expert on the short-term market, Ira Jersey, running all of our interest rate strategy at Bloomberg. Just is really wonderful on short notice to get Mr. Jersey on here this morning. Ira, there is a growing amount of a wall of money in the repo market. The authorities say remain calm. Others say not. Which is it?
You can, I think, remain calm in knowing that the Federal Reserve is aware of the situation where they don't want interest rates to turn negative on a systemic basis. I think that the Fed is worried about the financial stability of interest rates being negative in the U.S. and wanted to certainly try to alleviate that situation. So the way that they did that was by raising those two key interest rates last week. But I think the other thing, Tom, is that we have to look at taper as a way to alleviate that, because this whole situation is being created by the Federal Reserve continuing their asset purchases at the scale that they are.
Okay, but what's so important here is, unlike Europe, we have a massive money fund complex. All of our listeners and viewers know this as well. The Fed clearly wants to defend money market funds with positive interest rates. Even if they could make a penny, would be great. Ira, who do they serve? The money market rates that we all own, or do they serve a Fed that's trying to unwind this wall of money? Which is it?
Well, So I think the challenge here, Tom, is how does the Federal Reserve not give a subsidy to money market funds, but at the same time, try to fulfill its mission of helping the economy. And I question whether or not at this point quantitative easing and buying all of these assets, if it's not actually helping anything, because there's other constraints on why this money is not necessarily going to help anything except asset prices go up. Because reserves, bank reserves, which are what's created when the Federal Reserve buys a bond, can't be lent to the public sector. So they can't go to businesses, they can't go to the household sector. So base money keeps on going up and up and up, and it still has to find a home. So it's creating, and this is not unusual. I mean, we actually had the same situation in 2011 and 2012 toward the end of the quantitative easing period, where interest rates were zero and potentially negative, because basically these reserves aren't wanted, because there's things like Basel regulations where banks don't want to hold all of these reserves. So I think the other thing that can be done, and is a relatively easy fix, is to exempt these reserves from some of the Basel regulations, and not necessarily all of them, but from the supplemental leverage ratio in particular, so some of the larger banks can hold these assets, because they don't present a risk to financial stability if they can just be held on bank balance sheets for not a lot of cost.
So if anyone is not deeply entrenched in the rate dynamics, this seems like an esoteric debate, but it really goes to the heart of the quantitative easing debate, which is, at this point, is the Fed hurting more than it's helping? Does it need to taper because its excess money that it's pumped into the system is causing all of these problems? What do you think as far as the taper debate and when the Fed will start, especially because actually their assets on their balance sheet rose more than on average over the past year? We've seen them actually increase to the highest levels, a new high of more than $8 trillion. How close is the Fed really to tapering?
Yeah, well, based on the comments that Chair Powell made last Wednesday and Bullard made late last week, and I think that you'll probably hear a little bit more this week, it would not surprise me at all if they actually started tapering in the fourth quarter of this year. We'd originally been first quarter of next year, but I think that they're getting closer to the idea that, hey, we can still have easy monetary policy even if we start reducing our asset purchases. The important thing about asset purchases in general is it's a signal to the market that we're not hiking, right? Because the Fed is not going to start raising interest rates while they're buying assets, even if they're buying just a little bit. So one of the suggestions that kind of I've made last week was, they could reduce asset purchases from $120 billion a month to $20 billion a month, and just buy a lot less. Let the market be able to more easily absorb all of these reserves that they're creating, just because they're creating smaller amounts. But even if they're buying $20 billion, they're not hiking. So there's still a signaling tool that they can use with these asset purchases, just by reducing the amount that they're buying on a monthly basis.
Ira, does a 1.45% on the 10-year Treasury yield make sense in a world where the Fed is talking about tapering?
So it surprised me a little bit that we did rally, but I think what the market's saying to us right now is we think that the Fed might actually, in early taper as well as potentially earlier hiking, which I don't necessarily think that they'll do in terms of raising interest rates, but that they're going to be able to squash the inflationary problem that some people think might be out there right now. So what the market's telling you is, hey, we're not necessarily making a policy mistake, but that policy rates aren't necessarily going to go above 1.5%. So even if the Fed does hike, it's only going to be 4 or 5 times, and then they're going to stop. And the big thing that I think we're all missing in this whole all these market moves is the fact that real yields have gone up, 20 basis points, and inflation expectations have come down 15 basis points. And I think that's we can't lose sight of the fact that the market's thinking the Fed is going to keep a lid on inflation at some point, and their reaction function maybe wasn't quite as lenient as we thought it was going to be in terms of their ability to absorb more inflation.
Ira Jersey, thanks so much. Greatly appreciate it. With Bloomberg Intelligence this morning here on fixed income. And again, extraordinary movements here. The yield again. Well, the yield's higher. We've gone up 2 basis points in a blink, 1.46% on the 10-year yield. Lisa, it's the Qatar Economic Forum. The South African president speaking right now, Cyril Ramaphosa, to our Zayan Verji, and he's making headlines here, and he doesn't mince any words. They need the vaccine.
Yeah, this all speaks to the divide in the world between the haves and the have-nots, and very much it has become a developed versus developing nations. How much will that be in the focus here?
Qatar on the Persian Gulf, of course, around their rivals Saudi Arabia and others, Bahrain, and they've made very, very clear this forum will have a bias to Africa and the challenges of the Middle East. We're thrilled we could be part of the Bloomberg Economic Forum in Qatar. This is Bloomberg. Good morning. Good morning, everyone. Bloomberg surveillance, Lisa Abramowicz and Tom Keene, John Ferro off Kaylee Lines with us this morning as well. I want to reset right now at 8:30. Maybe there's no economic data or less economic data, but what there is an exceptional Monday across equities, bonds, currencies, and commodities. Kaylee Lines making a splash with a Merrill call of $100 oil, $3 a barrel on Brent crude. Oh, excuse me, I misread that. Yes, $73 a barrel on Brent crude. The problem you run into, Lisa, and I mean, I just went down in flames because I'm looking at Brent crude, but dollar ruble is also 73 to the dollar.
Yeah, that's all of
so
our
I was looking
problems.
at dollar ruble as I was looking at Brent crude as well. Lisa, I look at the bond market now, and seriously, how do you make a forecast in this?
It really is a faith-based forecast. It goes down to whether you believe that inflation is going to surprise to the upside, what your belief is about the reaction function of the Fed, and frankly, the just dynamics with all the cash out there, the idea of foreign buying. Should the U.S. rate start to rise enough for the highest yielding shirt in the sandbox actually having some value? How about that for mixed metaphors, Tom?
Yeah, you just went down in flames on that. I'd never expect that from Kaylee Lines. Kaylee, speak to us in English about the shirt in the sandbox.
I'm coming up empty, Tom. I'm still trying to dissect the different parts of that sentence that Lisa just said. It's been a while since I have been in a sandbox, I will say. What I'm looking at, Tom, is the dollar. After 6 consecutive days of dollar strength, we get broad-based dollar weakness in the G10 space today. And I wonder if that episode of dollar strength is over, or if we are going to see it resume, and how that reads across into the other asset classes.
The chart is out there. We've had a wonderful, eclectic set of guests this morning. Jane Foley coming up as well on FX. Laura Rame joins right now with FS Investments, their chief U.S. economist. And Laura's acclaimed for writing these short bullet research notes where she says, would everyone just stop it and look at the obvious elephant in the room? And Laura, you absolutely nail it this morning where you say the elephant in the room is nobody can make a 2-year forecast. We got to give it up. If we can't make a 2-year forecast, what do we do?
You got to try, Tom. I think that's, what we do. But Everybody, I think, looked at the Fed's forecast and they immediately started penciling in these rate hikes. The reality is that the dispersion of those 16 Fed members is so wide now. There's clearly a lot of disagreement. And that's where trading gets interesting. Obviously, that's where the volatility picks up. You're going to have all these guys talking. We don't have a lot of economic data early this week, so we're going to be watching the tape for what these guys say. And I think that is going to continue. We've already started off Monday in a particularly volatile session. I think it'll be interesting to see where that goes from here, because you've got the real hawks, you've got Powell tomorrow. There's this, I think, real soul searching on the part of the Fed. Do they believe their own framework review? Are they okay with the economy running a little bit hot and inflation maybe running ahead of where they've traditionally reacted?
Okay, but it's a theory. I mean, you and I have been doing this for more than a few years, and the basic I would suggest right now is we are truly, I mean, it's a cliche, folks, but it's Cliche Monday on surveillance. Let's go with it. Laura, this is original territory. Nobody really knows 2 days or 2 years.
I couldn't agree with you more. And what is driving me a little bit crazy is a lot of the very respected, very intelligent Fed governors sort of running back to these traditional Phillips curve models that they have built and thought so carefully about in a world where we saw those models completely break down over the last 15 years. And looking ahead, I think we're going to have real issues deciphering this data. What does it mean when the unemployment rate falls, precipitously fast, when you've still got so many people out of the labor force? Just one example of how interpreting this data, you can't paint it with the same brush that we've been looking at for decades. But I think for the Fed, those are the guideposts they're used to. And markets, it's complicated enough for markets to be dealing with this much uncertainty. They need to get familiar guideposts from the Fed, and that's what we're seeing.
Laura, if you're talking about how difficult it is to make a 2-year forecast and yet you have to try, let's put you on the spot. What are you looking at in terms of inflation, and have you changed your view based on the fact that the Fed is getting a little bit more aware of the potential for the economy running too hot?
I see this inflationary cycle, and I'm always up to the task, Lisa.
Good.
I'll always give you the forecast. I'm seeing a mini cycle in inflation. And I think, to me, the smart money needs to really be watching wages. Headline inflation is going to continue to give these distorted, offsetting, supply shortage-driven signals for some time. But I think underlying all of that, we need to really see the trend in wages. If that picks up significantly and it's sustained, then I think I really would rethink my forecast right now of this really being more of a mini cycle where inflation is back to the 2% range that it was historically, and by this time next year.
Laura, when you talk about wages, I also think about the shift in the economy where some people are worried about a higher out of work or sort of a lower participation rate in the labor market. The idea that the skills needed to fill some of the roles that are available right now are skills that a lot of the people who lost their jobs during the pandemic may not have. How does that factor into wage increases? Does it matter which workers are seeing their wages increase?
So for inflation, it definitely does, because most of our workforce is this sort of what we say is unskilled. That's because they've probably just never been trained up on the skills, labor force. And that over time has dragged wages down to the extent that this cohort can start through competition demanding wage increases. You could really see the financials of these companies that depend on this low wage area really change. It squeezes the profit margins. It does all the things that could cause companies to pass price increases on. But to your point, what we've seen is a pretty significant shift in geography, in jobs required. All of these things, I think, could eventually lead to higher skill workers. Companies may find themselves needing to train these people up. I think that would be the best case scenario. What we'd like to see is more skilled workers earning more money, not just low skilled workers.
Laura, we of course all are watching the labor shortage and we're watching the wage implications of that. And I know the wage data is very important to you, but what other data are you paying close attention to here? When we talk about how noisy and messy these economic reads are, what are the key points you're watching? And does any of it really matter until we get maybe cleaner reads in the fall?
You know, I think on the inflation front, stick to wages. But when we look at other indicators, I think the lending numbers are going to be really important. We've seen banks be really good about maintaining discipline when it comes to lending. And I think they really need to keep that going with this much liquidity and loan demand starting to pick up again. I think that's going to be a really important feature of how sustainable our recovery can be. And then from here, I think we start to think about 2022. Still a strong year for growth, earnings, but it's likely to be a year of deceleration from here. I think we're hitting the high watermark for growth right now, and a lot of people haven't fully grasped that. This is kind of as good as it's going to get for GDP.
Yeah, if we're peaking here, what kind of deceleration do you see? How much slower will the growth get?
Well, this is where so many people are missing the impact of the labor supply constraint, right? Our economy needs everybody that it can get to sustain growth, or even to sustain growth significantly above that 2% level or 2.5% level. If we have a lot of people that have chosen to exit the workforce, we're still down 3.5 million people, not lost jobs, people who have just either retired early, stayed home. All of that becomes a real constraint on growth, I think, more quickly than most people are willing to appreciate. So,
Laura,
yeah.
We got to leave it there. Laura Rain, thank you so much. Great brief there on the 2-year forecast. She nailed the 2-year forecast with FS Investments this morning and their chief U.S. economist as well. Lisa, I remember when most economic reports always modeled out a 3 or even a 5-year economic forecast. That disappeared about 15 years ago, you know, even before 07, but certainly with 07. And now, I mean, can you really go out to 2024? You know,
I mean, can you go out to December 2021? Honestly, yeah. I mean, where are we going to be when you look at the comparisons in the data and you look at sort of the inflation debate and wages going up? I mean, the labor frictions that we still have not understood fully.
I agree, the mystery of the labor market, but the other thing I'd look at, Lisa, is this basic idea of what are earnings going to do? How do corporate officers adapt business-wise and financially to what the Fed has wrought in the last few days?
Well, Kaylee kind of nailed it. And Kaylee, you were talking about mergers and acquisitions, this idea of companies just buying each other because they had a lot of cash and money is really cheap to borrow. And we're expecting to see a lot of that. The question is whether they can actually create some synergies. I hate to use this word, but we are cliche Monday here, as Tom said. And then going forward, whether this just means cutting staff, Kaylee.
Well, it's a very good question, Lisa. And of course, what the read-through is to, as Tom said, corporate earnings, because we were just talking there with Laura Raim about growth peaking out now. But talking about earnings growth, that also is expected to decelerate. These companies are going to be facing very, very tough comparisons. So if earnings growth is decelerating, economic growth is decelerating. If we're peaking out here in the second quarter, what is that going to mean for returns going forward, Tom?
We will have to see. I'm just not really sure. I mean, Lisa, you know, nailing it must be in the air. That's all I can say, Lisa. I mean, nailing.
Do you want to nail something to the wall? Coming up,
Someone get Tom a hammer.
I'm hoping that Jean Bovin, head of the BlackRock Investment Institute, I hope she can nail it and get a sense of what we can expect going forward. I'm not nailing it. I'm going down in flames. That's how we go.
That's okay.
But no, honestly, we're going to drive the conversation forward on the open.
But in defense of Lisa, I've had people in Montreal, Canadians, I called she. And that got me nowhere as well. John from Coventry emails in right now. He says Kaylee nailed it as well.
She did.
Nice to hear from John.
Oh, you guys. Thank you, John.
There's Jean Bovin. He is wonderful. Wonderful. I really can't say enough about Jean Bovin. He's one of the brightest minds out there in greater macroeconomics. He is a BlackRock and always must listen. I really must say that. Again, we're looking to Qatar and the Economic Forum out there. Some good guests coming up, including the former Treasury Secretary, Steven Mnuchin.
With the First Word News, I'm Kaylee Lines. Iran's president-elect says he will not negotiate over Tehran's ballistic missile program or its support of regional militias. Hardline cleric Ibrahim Raisi, who recently claimed victory in Iran's presidential election, also says he would not meet with President Biden. Negotiations have been taking place in Vienna to try to save a deal meant to limit Iran's nuclear program. There's political chaos in Sweden after Prime Minister Stefan Löfven lost a confidence vote in parliament. That toppled his minority coalition and leaves the leader with 1 week to decide whether to call snap elections. If Swedes are forced to head to the polls early, it would be the first time since 1958. Authorities in Hong Kong will shorten quarantine time to 7 days for fully vaccinated residents traveling from most places. They're also set to cut the requirement for non-residents who are vaccinated. These are the most significant moves yet to ease one of the strictest border curbs in the world. Other plans include lifting capacity restrictions at some restaurants and swimming pools. And European natural gas extended its unprecedented rally as supply curbs sent prices to their highest level in nearly 13 years. The gains are fueling concerns about inflation. Gas is so scarce in Europe that some utilities have turned to burning more coal, a setback for the fight against climate change. And Bitcoin fell to a 2-week low amid an intensifying cryptocurrency crackdown in China. China has ordered payment platform Alipay and domestic banks to not provide services linked to trading of virtual currencies. The institutions were also ordered to cut off payment channels for crypto exchanges and over-the-counter platforms, the People's Bank of China said in a statement. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lines. This is Bloomberg.
There's so much money floating around that it was putting downward pressure on money market rates, call it commercial paper, et cetera, and 3-month LIBOR, which reached an all-time low of 13 basis points last week. And so there's still, that money still is out there, so to speak, and it won't be removed for a long time.
Tony Crescenzi of PIMCO, extremely important conversation there on $1 zillion trillion piled up, a wall of money that won't move right now. These are real complexities. And to all of you watching this, maybe that haven't gone through the curricula Lisa Abramowicz has gone through or Kaylee Lines has gone through, it's real simple here this morning. The pros are as befuddled as you are as well. We're just trying to explain it. A major shout out to the surveillance team that worked through the weekend to give you smart voices on this. Stephen Stanley publishing moments ago at Amherst Pierpont makes really clear we've given up on studying the supply side of the American economy, and we've got to do that right now. And also as well, Mark McCormick at TD Securities, who was strong dollar like Jane Foley. McCormick just looks for strong dollar to endure here. Jane Foley joins from Rabobank. She's been dead on, and what's so important, folks, is her price targets are moving. I mean, the idea of you get a price target and a cup of coffee later, you're halfway there. What do you do with your movable feast of FX targets? Jane, how ugly has this been, and how do you adapt and adjust at Rabobank on a Monday morning?
Well, to be honest, my 1 month target at the end of in the middle of last week was at 120. I haven't changed that yet because we could have a little bit of price adjustment, but I do think that the dollar is going to remain strong, certainly into the rest of this year and certainly this summer. I mean, there had already been a lot of focus on Jackson Hole. Maybe that was going to be the meeting where the Fed became, more hawkish. But I think what we saw last Thursday clearly really surprised the market. And what we're seeing now is a huge amount of dollar positioning just being squeezed out here.
Well, the dollar position's been squeezed out. I got a little static on the line. We're going to keep going with Jane Foley, see if we can get that. That's, Kaylee, that's what happens when the mice eat the wires.
Hate it when that happens.
We leave 731 Lexington and the mice come in and working the wires as well. Jane, I look at the Pacific Rim play just as something that we haven't talked about today away from the majors. And there's just been this, idea of better economy, Pacific Rim excellence. If I get a strong dollar, I can't get Pacific Rim currency strength. Which wins out?
Well, I think in the short term, it's got to be the dollar. But what the Fed has done last week does potentially allow other central banks to put a different slant on their policy. So, for instance, if we consider, the RBA, the RBNZ, those economies have been pretty good. They didn't really dive that much last year compared with other G10 economies. They've had really strong rebounds. And yet the central banks, or particularly the RBA, has remained pretty dovish, not so much the RBNZ, but you could argue that now that the dollar is strengthened and their currencies have come off, that this could really open the door for other central banks to be a little bit more hawkish too. Now, you could potentially apply that same sort of logic, maybe even to the Bank of England, maybe even to the ECB. To what extent does this open the way for other central banks to subtly change their tone? Now, we're not necessarily expecting the shocks that we've seen from the Fed. I mean, look at the yield curves in the UK and look at the yield curves in Europe and Germany compared with the US over the last few days. We haven't seen that much movement. But, it could mean that we will see more central banks being brave enough to come out and being a little bit more hawkish because they don't need to fear that their exchange rate is going to start zooming higher.
Well, and that's on the developed central bank side, right, Jane? And when you look at emerging markets, the Bloomberg or the MSCI EMFX index right now hovering around its lowest level in a month, obviously on the losing end of that dollar strength equation. And we know that emerging market central banks have been raising rates. They have been tightening policy. They are trying to combat rampant inflation when you look at the likes of Brazil and Turkey. Are they going to be able to provide enough support to their currencies?
Well, I think at some point we've got to look at the various different emerging markets, in their own, given their own fundamental capacity, rather than look at the group as a whole, because some are better positioned than others. But clearly, in terms of there being a stronger dollar, in terms of there being a Fed who's a little bit more hawkish than it was before, that is clearly bad news for the whole of EM. But we still got to remember that, the Fed is still being accommodative at this point. It's just a little less accommodative than before, but still accommodative. So from that point of view, there will be still value in some emerging markets. But it will be the investors that are able to, put apart the different EM countries and look for the ones that can still offer value.
Jane, of course, we're getting the Bank of England decision later on this week. And right now I'm looking at a cable rate 138 or so. It is the pound is the strongest performer in the G10 space today. What is your base case for the pound?
Well, we have seen, obviously, sterling come back against the US dollar in the last couple of days. That's not the same sort of story that we're seeing in sterling against the euro. It's been still really very range-bound, and although it's moved a little bit, it's still towards the end of the lower end of its range. Now, the Bank of England, as you said, is clearly in focus. Probably not going to be that much on offer, but I think the market's always expecting that Chief Economist Haldane, as he leaves the bank this month, will come out with some hawkish parting remarks. So I think the market's positioning for that, but I think there isn't going to be any particular surprises over the summer. But later in the year, we could have a little bit more tapering from the Bank of England, so we need to watch out for that. But that assumes, of course, that the slowdown and reopening the economy in England doesn't impact confidence too much, that we still carry on and see the remaining reopening of the economy take place in July.
Jane Foley, thank you so much. Greatly appreciated on a tumultuous day. Kaylee, I just look at the 10-year yield. I mean, rounded up to a 1.47%. I don't know where we were when you and I walked in the door, but, we're bordering on a 10 basis point move.
We were sub 1.4%, Tom. I think at the lowest point in the session, we were looking at a 136. So the move has really been quite remarkable, not just today, but of course this follows yields getting whipsawed last week. Your knee-jerk reaction on the back of a Fed with the dots getting pulled forward 2 hikes in 2023 was yields higher. And then we saw that bid coming into the long end. We saw that flattening trade. Maybe it had to do with some short positioning being covered, but obviously the dynamics very interesting to watch today because we are seeing the selling pressure coming back in the bond market. We're up 2 basis points, Tom.
Yeah, the research right now is just extraordinary. Everybody's publishing with a frenzy. It's much more different than a normal Monday as well. Just very quickly here, Kaylee, you got to watch the VIX 20.36. I got to believe it explodes through to 19 level to show the calm in the market.
Well, we will wait and see, Tom. right now. NASDAQ 100 futures rolling over toward the lowest we've seen really since about 4 a.m. Eastern time or so, only up about 0.2%. S&P, though, faring a little bit better. So maybe that reflation trade will actually get back in vogue today, Tom.
He is a chemical engineer from India, and he was at Stanford, and his father said, come back to India and help build a startup company, Reliance. He has done better than good. Our host Linda Amin in conversation with Mukesh Ambani of Reliance Now. This is the Qatar Economic Forum, the Bloomberg Forum. We're thrilled that he could join us today. A real focus there around the world. Stay with us through the morning. This is Bloomberg on radio. And I'm